All right. Is the countdown off the screen? Welcome back, everyone, from lunch. Hope you enjoyed the hot buffet. I'm very pleased to introduce our next speaker to kick off our afternoon session, Ryan Selkis, who's the co-founder and CEO of Messari, a cryptocurrency data and information provider. Prior to founding Messari, he was entrepreneur in residence at ConsenSys and was on the founding teams of Digital Currency Group, where he managed the firm's seed investing activity, and CoinDesk, where he led the company's restructuring and annual ConsenSys conferences. He has been an investor and prolific writer in the crypto industry since 2013. And what Ryan and his team are doing is very important work to bring professional legitimacy to a space that many in the mainstream will view as shady. Welcome, Ryan.
All right. Thank you, everyone, for having me. Thank you to Aon for hosting. It's been a great event so far. So for those that don't know me, it was a very nice introduction. I'm Ryan Selkis, co-founder and CEO of Messari. And you can think about what we're building almost like an S&P for crypto, right? So what does S&P do? They do ratings, they do indices, they do market intelligence solutions, mostly geared towards professional investors and just professionals in general that are trying to keep tabs on equities, fixed income instruments, traditional legacy financial products. And right now, there's no such thing really in crypto. There are certainly some fledgling data providers, some fledgling information services, but the reality is that it's a bit chaotic. So we come in with the thesis that there's going to be an enterprise vendor that professionalizes reference data and actually comes up with tools and historical charting capabilities and dashboards that make it a little bit easier for professionals to come in and make sense of this market. And the reason we're doing this is because we believe, as I'm sure many in here do, that this is going to be a $10 trillion asset class. How do you standardize data in this particular asset class, though? It's a much different challenge than legacy financial instruments because this asset class trades globally. It's not necessarily clear which regulators are responsible for overseeing some of these assets. And when that's the case, it's unclear whether and if the asset creators themselves have any responsibility to make disclosures around how they're managing the projects or submit any type of reference data, either programmatically via their smart contracts or through some type of global or national regulator. And so you think about Bitcoin, who speaks on behalf of Bitcoin, right? That one's kind of a loaded question. There is no, there was a Bitcoin Foundation, it was a disaster, but there is no Bitcoin Foundation, right, that speaks on behalf of Bitcoin. Ethereum, there is an Ethereum Foundation, but you can argue that it's got a very small, in some respects, impact on the financial decisions of Ethereum at this point because the ecosystem has grown so decentralized. But then you start going down the list, Binance and BNB, Augur and Rep, 0x. How important and influential are those core teams that ran token sales, that created these assets, and that are ultimately responsible for not only managing the code and delivering the protocol, but thinking about the distribution of the asset itself? And really, we're seeing maybe not even the second inning, but we'll call it top of the second for this industry. We're just talking right now about currencies, commodities, and protocol tokens. In the future, our thesis is that all manner of financial assets, whether you're talking about securities or other financial instruments like debt and derivatives, are ultimately going to be traded on these public protocols. This technology, we think, is going to be as transformational for finance as the internet was for publishing, appreciation of the choir. We call this slide our great filter when we're talking to investors. If you don't believe this, then the conversation is going to be pretty short. But that's where we are today. So on the data side of things, you really need a few things. One, there needs to be some level of transparency and granularity with respect to these assets or protocol tokens and the teams that create them. There needs to be some mechanism to curate all of the unstructured information that tends to proliferate across social media platforms, company blogs, informal updates, and actually consolidate that in one place so you can help a global stakeholder base for many of these projects actually understand what the hell's going on. And last but not least, you got to put all this information into common data structures that will ultimately allow professionals to do benchmarking exercises and compare these different assets, ecosystems, apples to apples, or at least create taxonomies that would allow you to bucket a protocol token versus a crypto asset versus a work token that you must stake in order to earn network fees, et cetera. And in the early stages of Messari, we've kind of taken a trust but verify approach, or maybe we don't trust people as much as we should or shouldn't, but we at least assume good faith with most of the projects that have actually raised funds and are trying to deliver these assets. The problem is in just the last quarter even, as we started to drill down with a full research team onto how some of these assets are managed, we discovered that in just the top 10 assets alone, one of the top 10 assets had a $6 billion market cap overstatement. Oops. Another had a 20% inflation bug that had previously been unreported, and you wouldn't actually be able to find in their block explorer unless you went and looked at a fork of the ledger from another crypto asset team and did the forensics to see that back in 2017 that there was this inflation bug and then a subsequent burn and reconciliation that had previously been unreported. So trust but verify, yes, but when there's demonstrable evidence that you can't necessarily trust token team creators to be not honest, but at least thorough in terms of what and how they're disclosing about their projects, you need some type of independent third parties to come in and hopefully apply some social pressure and some common sense when it comes to transparency standards. The information curation element is a little bit easier. I know Slava's in the room. I think he's presenting a little bit later on a panel what Relevant is doing to curate information in terms of social feeds is very interesting. There's a couple of companies that are working on PeopleRank versus PageRank with Google. PeopleRank, how can you actually score contributions and ideas based on who follows that person back? There are a number of ways through social scoring and then ultimately I think through machine learning that you'll actually be able to curate high signal information from a variety of these different sources. But right now, the gating item is not data, it's just a single repository to actually collect all this information and help republish it and let investors and other stakeholders decide for themselves what's real and what's not. And then finally, with respect to data standards, we know that a lot of things are broken in the industry in terms of how we talk about market cap, how we talk about exchange traded volumes, how we talk about even spot price, which is crazy to think about. This asset, Bitcoin at least being over 10 years old, and we're still having trouble coming up with a daily volume weighted average price, and it's because of the unreliability of many of the global exchanges. So we think that if enterprises are going to enter the market in any meaningful way, we're going to have to clean up some of the challenges with respect to the low integrity data and just information disorganization that we see as the status quo. And I don't really mean to pick on them, but I will because they're kind of a competitor. So CoinMarketCap, the only problem with CoinMarketCap is that all their numbers are wrong. Starting with just the market cap metric itself. So in the public markets, what you would expect with an equity, for instance, is that the circulating supply would represent that which is currently outstanding and not held by affiliates, company, associated foundation, or founders. And there's a certain implicit understanding there that if you're using a free float methodology to value a public stock, you actually understand what the private stock still is and what the founder stakes are, what the company stakes still are that's held in reserve. Within crypto, there is no such expectation. And that made sense back when it was just Bitcoin and Litecoin and some of the forks that were decentrally issued and then ultimately mined via proof of work or some other type of fair launch algorithm. But for assets that had either a pre-mine, a central foundation that manages treasury, or some type of discretionary oversight for how their assets are liquidated, there's a missing piece of the puzzle, and that's disclosures. We're going to talk a little bit about some of the other metrics here a little bit later, but suffice it to say, it's not just on the crypto asset creator side, it's not just on the exchange side, it's a little bit of everything in terms of where we need better standards and transparency. So token project disclosures are important. I think it's important. This isn't just like a feel-good exercise. This is material, right? So if you look at some of the top assets, there is implicit inflation that is hidden from view if you just look at the consensus algorithm and you just look at, in many cases, the developer APIs associated with some of these projects that have large centrally managed treasuries. But if you factor in what is ultimately liquidated over time, whether it's months or years, whether there is a written contractual agreement for how they will structure their selling, or whether it's just completely up in the air and at the discretion of the team or the founders, you've got double-digit hidden inflation for many of the top assets that are very liquid and in retail hands today. XRP, they say that about 40% of XRP has been distributed. Our analysis back in January shows that conservatively it might be 20% outstanding. We actually think it's even lower than that. Stellar, 13% of the circulating supply is outstanding. You contrast that with something like Zcash, and you can see Zcash, as a proof of work coin, has 40% annualized inflation right now. Key difference, though, is almost all of that is known, right? It's mined. So you know that from day one was going to be the issuance schedule, and 33 points of that 42% is embedded in the core code. And by the way, the other 8% was also known from day one. And these are the Zcash Foundation or Zero Coin Electric Companies reserves that were intended for the founders and the teams to fund operations. So you can see that there's a very meaningful difference. And by the way, these are just estimates because that XRP number, that Lumen number, the Tron number, that could be 0% or it could be 50 or potentially even higher. And it has to do with how these teams are ultimately able to market sell some of these assets depending on the movements in price and depending on the health of the market that they're selling into. So how do we aim to fix that? Well, we know that there's a bunch of unstructured information in the industry that folks want to see in one place anyway. We recognize that some of this reference data is not necessarily reliable. So what we did is we said, we don't think that these are securities. We also don't want the SEC and their global counterparts to crack down on this industry and stifle innovation and treat everything as if it's a security just because of the excesses of 2017. So what we want to do is we want to come up with some non-controversial, objective, verifiable, and actionable or material data points that we could collect from all of these token creators. And that will serve as at least the front page of a profile that would help stakeholders, investors, developers, miners, you name it, quickly come up to speed on a given project. All of the information could be immediately republished, retransmitted to any other third-party data service, any exchange, any regulatory body, any researcher. It's a single source of truth for the industry. So this isn't just about supply, but it's about the teams, it's about the technology roadmap, it's about the token details, or at least how they're intended to function. It's about the organizations that might be involved and where they're domiciled. Does this entity have a law firm affiliated with it? There are a couple of folks that we're working with that actually wound down operations of the entity that sold the token, created the token initially. That's material. You'd want to actually understand if this is truly a decentralized project because there is no entity that has any claim on IP, nor does one exist that even actually hires and pays salary for employees. To date, including Aion, we've got 30 top teams from around the world that are participating. So 20% of the top 30 assets, Zcash, Cosmos, Maker, AirSwap, Zilliqa, Qtum. You can see the names up. Well, they're a little bit small, but you can certainly check them out and either squint or go online. But what's important is that all of these teams look and feel very different. You've got some that are bona fide currencies. You've got some that are work tokens. You've got some that are payment tokens. You've got smart contract platforms, interoperability solutions. All different flavors of crypto asset projects have bought into this. And by the way, we're speaking with dozens, over 100 more, and plan to onboard at least 2x the current amount by the end of Q3, so within the next 4 or 5 months. And this is important as a backbone because once we actually hit a little bit, I think we're getting close to the inflection point for this particular project, but once we do hit critical mass, the question for non-participating projects becomes, why aren't you participating, versus trying to have to actually sell every single entity and individual that's affiliated with the token project. Why should we participate in this? And we're thrilled to have the support of these teams, but more importantly, it is not just good for the industry, and it's ultimately good for them, right? So what does reference data 2.0 look like? How can you come up with a consistent plain English summary of how the project functions? How can you come up with dozens of KPIs that the teams themselves are tracking to monitor the performance and health of these ecosystems? Can you be transparent, not to the line item on the balance sheet or income statement, or being overly transparent with respect to salaries or vesting rewards that would potentially cause safety issues or OPSEC issues, but how can you at least help people understand where their money is going from the token sale? How folks are incentivized over time, what this project looks like, not just in the peak of euphoria in 2017, but as it gets built out. And we've been able to do this for 30 projects now and are making our own best efforts based on a market cap prioritization schedule to fill in the gaps for many of the other top assets. The issue is we can't do it because some of it is just discretionary on the part of the team that's actually created these assets and holds treasury or holds the keys to the code repos. So we need a little bit of buy-in from folks on that side of things. And right now we're off to a good start and distributing this data to a number of third parties, some of which we'll be announcing in Q2. But I'm not going to spoil you and got to hold off on a couple of those. So ubiquitous information is going to be killer for us. And what we really want to get to is the point that we can start going a layer deeper for many of these assets. So we talked about token supply quite a bit. And I talked about supply because it's such a remedial metric that it seems obvious that we should have figured this out by now, how to actually report on circulating supply or vesting schedules. We haven't even been able to go a layer deeper. And one thing that's a pet peeve of ours is once we understand the vesting schedule, the inflation schedule for these assets, we can actually demonstrate to folks that in some cases are just getting flat out duped by this staking rewards movement. We can show them that while you are earning 5% in a staking yield, quote unquote, there's 6% inflation annually. So net, if you stake your coins, your tokens, you're going to lose 1% a year. And by the way, you're going to have a bunch of tax issues because no one knows how these are going to be treated once you actually get a staking dividend. So this is where the rubber meets the road if you're thinking past a greater fool type of investing thesis, like we saw in the run-up and the original ICO boom. This is what the professionals are actually going to care about. They're going to want to see, is there any fundamental value in this asset? And they're going to be able to see through the bullshit if a staking yield is 5% headline, but there's 20% inflation embedded in the system. That stuff just doesn't fly, and I think the good teams are starting to move past that. All right, so back to our very dear friends at CoinMarketCap. On the right-hand side, this is the exchange ranking list, and the red are all the inaccurate numbers, often by an order of magnitude. And these are exchanges internationally that facilitate wash trading at, in some cases, epic scales. And wash trading is basically just illegitimate trades that don't really exist. It's just the same counterparty trading back and forth with themselves and inflating volumes so that they can climb up the rankings on a site like CoinMarketCap. And it's not just them, it's a number of others as well. And right now they've gotten away with it because it's hard to actually track this if you don't have an internal team that's scrubbing the APIs and conducting forensics on what's going on internally at the exchanges. But if you do, and you start to pierce the veil a bit, you can understand just how insane some of the overstatements are with respect to daily trading volumes. And this, again, becomes really important if you're trying to calculate a volume-weighted average price between exchanges, if you are trying to understand how much selling pressure 1% of a team's treasury would have on an illiquid market. If you look at something like EOS and you assume that 40 times as much trading volume is happening on a day-to-day basis than is happening in reality, you're going to come to a very different conclusion with respect to how much the market could absorb if there was a whale that market sold assets. And it's important for us to be able to go through all these assets, all these exchanges, and actually come up with some reliable figures, because if and when professional smart money investors start piling in at scale, they're going to want to know that they can actually execute trades and accumulate some of these tokens and participate in these ecosystems without having enormous slippage or without feeling like they're going to be defrauded by some of the teams that they're buying from. So that's the backbone of our business. We're a company that's built on transparency first. The first major product that we've shipped is this disclosures registry. We also have a dashboard that I encourage you to check out called On-Chain FX, which allows you to compare assets across 100 different metrics. We have 500 plus assets that are covered. So if you're really looking into the long tail of altcoins and tokens, then there might be some gaps, but the asset coverage gets better every day, and the quality and depth of coverage I think is second to none with respect to professional dashboards. In Q2, we're also rolling out different charting tools and allowing for historical data pulls for select metrics for our professional subscribers. And then last but not least, we have a data library with 5,000 people, 2,000 organizations, and are ultimately making it easier for folks to either search, filter, or market map some of the private and public token teams and non-token related teams that are working in some of these sub-markets. So categorizing the industry, coming up with some common taxonomy and reference data standards, and ultimately bringing, I hope, a little bit of sanity to the market. Last but not least, we talked a lot about transparency. It's right after lunch. I assume that most of you are in a food coma or really didn't want to talk about reference data because it's probably one of the more boring things that many of you are going to hear today based on some of the other speakers. And in fact, this is probably the least glamorous business that I could possibly imagine, building the crypto equivalent of Edgar, which is essentially a repository of quarterly and annual filings and prospectuses for securities and other financial instruments that is governed by the SEC. But if you don't have that, you can't build any of the cool stuff on top. And we think that starting with this approach is ultimately positioned us to credibly build some of the tools that don't just rest on a house of cards and rely on crappy data on the way in. So encourage you to check out Messari. We've got a daily research brief. We've got a ton of free tools that are available and shareable. And if you have any questions, I'm happy to open it up for Q&A with 2.5 minutes to spare. Are we doing Q&A? All right, cool.
Is this subscription-based?
Is it subscription-based? So what we do is we charge registry participants $10,000 a year in a license, which is essentially, you can think of it almost like a mini audit fee. We're not coming in and blessing the books or doing something like a Big Four accounting firm, but it does take our research team time to help prepare and scrub the disclosures that are actually submitted by these teams. We also use that as a bit of like a spam prevention feature, right? We don't want just anybody populating this information like Crunchbase, forgetting about it or having incomplete or stale information and having it be entire user generated, because then you have the same problems of crappy data in, crappy data out. But the other way to look at it, from an ROI standpoint is we said at the onset we were going to try to build a critical mass of projects that we're going to participate in this initiative and then build out the other side of the marketplace where we're actually distributing this to major exchanges and data aggregators. And we're basically talking to everybody that you would probably think of in terms of how they could leverage all this information themselves, and we push it out via free API. So that's the boring, structurally important business that we've started with. Above and beyond that, some of the tooling that we've built is enterprise software. So typical software as a service business. Should I cold call someone? Or are we at time? 48 seconds. We can do a lightning round. Spit out your favorite shitcoin. I'll tell you what I really think. All right, guys. Thank you very much.
Thank you, Ryan. Seeing Edgar on the screen just gave me a little nightmare of my old internship days at the stock exchange. So thank you for that. While we set up the stage, I do want to welcome our next set of panelists. We have a panel coming up hosted by Kareem from the Aon Foundation. And this panel is an investigation into the underbelly of blockchain node infrastructure. With many of the biggest blockchain protocols leaning heavily on centralized hosting services like AWS, it does beg the question, are our decentralized applications truly decentralized? Here to discuss this topic in detail is a panel of heavyweights who have built businesses to serve this problem. Welcome, panelists.
Oh, we're doing the seat of honor. There you go.
Cool. Can everyone hear me? Awesome. So thank you all for being here for Rebuild and for attending this panel discussion. And a big thank you to the panelists for making it out here. I know we have some really good representation across the board. My name is Kareem. I've been involved with Aon early on, and most of my work is primarily around ecosystem growth and the developer community. I also run the incentive program, mainly grants, to accelerate that growth. So I'm really happy to see some of the few grantee recipients on stage today. The topic we're going to talk about is Web3 plumbing and essentially the economics behind running decentralized infrastructure and how it plays out in the large scale of these systems. So I'm going to do some brief introductions for the panelists and dive right into it. So on my far left, we have Lorian Gable, co-founder of Figment Networks, who are focused on security and compliance staking services for public blockchains. They currently provide these services for Cosmos and other proof-of-stake systems, and Aon coming soon on that. Up next is Konstantin Reiter, who is the CEO and founder of Blockdaemon. They're a multi-cloud platform provider for leading blockchains, and they do very easy deployment for nodes within a few clicks. They will obviously have a chance to talk a little bit more about their services. Next up is Michael O'Rourke, founder and CEO of Pocket Network, building developer tools and easy-to-use infrastructure that is blockchain agnostic. They also release kind of other tools such as mobile SDKs. Next up and finally is Brendan Lee, CEO and founder of Nodesmith, who currently provide hosted node infrastructure services for Aon and Ethereum through easy-to-use API endpoints. They're also adding multiple networks coming soon as well. So to dive right into it, Konstantin, maybe asking you first. Infrastructure means a lot of different things for many different people. What does it mean for you and within a blockchain and decentralized context? Why is it very important?
Well, that's a great question. So the way, and I have a biased perspective, obviously. What we do at Blockdaemon, we're the first multi-cloud provider, so we've always believed in decentralization as, it's an ideal state. It's never full, nothing is fully decentralized. But there's different layers of decentralization, and I think over the last couple of years, we've seen an appreciation for blockchain networks to be decentralized, have decentralized hosting, so that you actually have nodes run for an individual network across data centers around the world. And so, and that's important for decentralization purposes, just because you don't want to be having a scenario, like some of the top 10 protocols had, where 20 out of 21 nodes sit on Amazon East, for example, in one data center. So you create these single points of failure. And so a decentralized infrastructure creates also a lot of complexity, because ideally, and we're just sort of starting to get there because the sort of current state of blockchain networks is still relatively poor, is how do you manage load balance and latency across those networks to actually efficiently, dynamically scale them based on where stuff is needed. And so for us, infrastructure is, we run infrastructure across Amazon, Google, DigitalOcean. We have our own data center. We believe that people should own their nodes. We believe people should own full nodes, specifically if they're active in a network, ideally, as a sort of network participant. And ultimately, our end goal is, we provide the hosting for all these different services, and we can move nodes and containers and swivel them around across that platform, is that we want people to bring their own infrastructure. And so it's really monitoring and managing of all the major networks for professional entities. And we think there's different groups of people who will pay for that, right? So there's staking providers, companies who want to pay us because they want to run nodes in a wallet. And then there's participants, foundations in the network, and enterprises, really.
Oh, that's a great answer, and kind of leads me to my second question on who the customer is for these decentralized infrastructure providers. Who do you go out for as a target customer that's maybe different than the traditional kind of cloud service offering? Who's the customers in the blockchain world?
Who do you want to ask also?
Sure, so we'll take it. So we, in our business, which, I think first we should have some definitional clarity around what a node is. I think it means something different depending on the context, even among this group up here. So you can have the nodes of what you were just talking about, which have a copy of the specific blockchain on them, or you could have validation nodes, which is what we do in our case, where you're processing transactions, securing the network. So I think it's useful to, in the space, a lot of times terms get merged and the definitions haven't been well thought out yet, so I think that's just one important thing to note. In our case, we really see as having two customers. One are the blockchains themselves and their community, so processing, providing security, processing transactions, hopefully there will be transactions, and then on the other hand, token holders who need to stake those tokens somewhere and they need a set of services around there. So that's in our case how we see essentially who the two markets that we serve are.
For us, just to answer the same question, at the end of the day, we are infrastructure providers, so our solutions are generally generic and can handle tons of different developers, tons of different applications. For Nodespace specifically, we see, the growth of this market is going to come from tons of new, traditional Web 2 companies entering this space, and so that's kind of our target developer right now is the new people coming into this space, and what they want is they want traditional, familiar SaaS experiences, and we think it's important to provide that, and that's what we're focused on right now.
So you mentioned SaaS. I think that's a very interesting and proven business model across the years. When it comes to blockchain where things are free and public and open source, people have some expectations when using these services, especially when there's like free options on the market. How do you as a business find a sustainable business model that you can monetize when the expectations are sometimes different than more traditional kind of centralized models?
Yeah, you can, I think there are traditional business models and there are non-traditional business models as well. I think you guys are working mostly in the traditional space where, getting paid for your services and doing everything. In our case, we're building a trustless network of an API layer. So in our case, each individual participant will be minting our cryptocurrency for each API request that they serve for the network. So, those economics are slightly different than they would be in the traditional world. But like what Brendan said, providing an interface that's very familiar to Web 2 and everything that you're used to before is super important because decreasing that barrier of entry is super critical for this adoption and for, frankly, our industries to grow generally. So
Maybe one way to think about this is the other side of that coin from a revenue model is to think of the services that are being provided here as a COGS line for these networks. So it's essentially the cost to run these networks. That the value, however you define value, is going to have to be created by the end users at some point in time that exceed what our costs are, however they're being paid for. So you're starting to see some of that analysis in the case of Bitcoin with what does it cost to pay the miners what percentage of the network. And for store value, I think it's a separate discussion, but for a lot of these blockchains of which they are theoretically going to have applications with end users who are going to be paying some form of value, whether it's fiat or the currency, that value is going to have to be greater than the cost of what we're doing to provide that service at the end of the day. And I think if you're at some point in the future, if you're looking to build on these networks, you're going to have to look at the cost. What are we charging in a generic sense? And then make sure that you can create more value than that in some way with whatever your application. So networks will, I think, become competitive in this respect on how low their costs are, although cost isn't the only reason or even an important reason on why you would build on a network, but I think that'll be coming. Maybe Messari will do that analysis. So.
I think one of the things that we see as well is that the actual cost of operating these networks currently is out of sync with the value these networks provide, right? So I think that's one of the key bits that we've learned because,
And a challenge.
Yeah, and we've been a traditional SaaS company and we do all types of nodes, we can run a complete network, there's all different bits and pieces. But what we've seen is that, I was chatting to people earlier about it, is people start these projects specifically in the crypto space and wanting to build an ecosystem, which is very laudable. But you can't have a decentralized ecosystem, you don't have that inflection point of zero, whereas people will just come build this open source tooling and everything will just work out and balance itself, And so the question really is, how do you educate the stakeholders, which are, really the foundations and beneficiaries, to actually fund the development of these networks so they remain scalable and secure. And we haven't really found a great way of doing it. Staking is the next one, which is, can you sort of build a staking network where people participate in the, get rewarded in native tokens, but that opens us up to the whole dynamic of the cryptocurrency markets, which suddenly turns us into a hedge fund, So that's why we, for example, stay away from it, just because I don't know how to do that. I know how to run a network and how to deploy nodes. Once I have to buy puts on individual small tokens and stuff, it gets complicated. And so the question is also for us, and we're traditionally venture-backed, right? So we're a small venture-backed entity, and so I gotta raise money again, I gotta do all these things, so I gotta mitigate risk, right? And so, but there's different ways to do this, for sure, And there's been great other projects, Filecoin, that kind of looked into different components of infrastructure that thought about it in a good way.
And you mentioned proof of stake. I think that's part of the evolution, right? We're starting to see these generalized mining platforms that are causing people to learn about infrastructure generally. How do I run my own server? What does that mean? How do I cache data? So I think this actual knowledge base is actually growing over time as well, which increases the base of people who are capable of doing this as well, which helps increase the decentralization over time, I think.
Maybe, because then the other risk with staking services is that the stakers aggregate enough investments that they control the network. Right, so what happens now with staking is that, something like Coinbase custody, for example, if everybody stakes tokens via Coinbase custody, then Coinbase ultimately controls these networks, right? And so one of the business models we've seen is staking foundations actually coming to companies like us and paying us to run validator nodes in that particular instance because they want to make sure, and participation nodes, because they want to make sure that there's outsiders who run nodes who can prevent that from happening. But it just creates a different risk.
And speaking about risk, the promise of blockchain and kind of open public infrastructure is trying to disrupt kind of the existing centralized providers. How do you balance kind of that decentralization and answer the critics that might say, the beautiful thing about these networks, they're run by individual nodes, but ultimately they're running off of existing kind of the same traditional cloud service providers. How do you balance that kind of decentralization? And how is that a challenge for your businesses?
Well, go ahead.
I mean, it's a great question, and one I'm sure we all talk about a lot. At the end of the day, we're not going to go from zero to full decentralization in a few years. It's going to be a long process, and we're just all taking steps to get there. Like Konstantin said earlier, running on multi-cloud environments, being cloud agnostic, that's super important right now, and I think that's what a lot of us are trying to do to at least make step towards full decentralization. But running your own data centers is really hard, and that's why these big companies have been doing it and making tons of money. And so we're not going to be able to go from where we are today to this perfect decentralized future immediately. It's not going to happen this year. It's probably going to take us decades.
Well, one nice thing about these networks is having been in the data center business 20 years ago, you're actually starting to see a return now to people running their own facilities and actually running their own hardware in data centers, which is nice. So for a decade, no one would build anything except in the cloud. And now I think we're actually seeing a return, both professionals and even amateurs, back to a data center facility. So it's kind of nice to see that.
And it's interesting because the rationale, and that's why we actually started running a data center, because there was a long time where everyone was like, oh, don't do data, obviously Amazon is gonna, and then we started running nodes, and we spun up our own little rack. And because these cloud companies make a killing, I mean, the margins they charge is enormous.
Leaving aside doing the work to do it, it's actually much less expensive.
Yeah, it's exactly. And so it's kind of interesting too when you actually look at the underbelly of how much it actually physically costs. There's a reason why all the cloud providers love blockchain as a service, is because they want to make sure that people run, large, decentralized, expensive networks on their very expensive services.
And it's a matter of investment too. I mean, Amazon, AWS made like over $20 billion last year, and how much of that goes into specific hardware for everything to work properly, right? I mean, there's very little of this in the open source world today, and it's going to take time for this investment to really go into what'll be helpful for open source networks, right?
I think you specifically, Michael, with the Pocket Network and launching your own kind of token to incentivize nodes to be running on these infrastructures for multiple blockchains, what do you see as the key challenge to get that initial adoption, and how willing are people to maybe monetize using more progressive, let's say, token-based models?
Yeah, well, like what Lorian said, I mean, you're starting to see people really get interested in running servers and participating in these data centers and everything. And when you have a crypto network where everyone is incentivized to participate, right, where you're staking and you're not only proof of stake, but generalized mining, and that unit of work is properly accounted for, I think you can actually reach efficiencies that are 10x, 100x of what a traditional system is, because through like cost of coordination, right? I pay someone $1 once a month. There's a lot that goes under that for me to pay you $1, right? Or even if I send you ETH daily, right? That needs to get validated by the network, and that itself is a cost. And I think through various new economic models, I think we're going to find really interesting efficiencies that were undiscovered previously.
One other interesting, one way we thought about it when we started was to actually, and it didn't work, but is have people make donations and pay us in crypto and then aggregate everybody's Amazon accounts, for example. So rather than having companies, do their own little, we buy a little bit of infrastructure here and there, we said, listen, to 100 companies in the community, give us all let's pool the resources and we centralize, we buy infrastructure on behalf of everybody. Obviously in a decentralized network, those things never happen, but it was a good idea. Because, kind of obviously the governance and getting everybody to do it at the right time and stuff proved super difficult. But that's another way you could, in theory, think about it. There are so many fun and theoretical exercises. Even if you look at the full computational power needed to power all these existing networks on full mainnet, I mean, we don't have enough data center in the world or energy to actually even remotely do it. So there's a lot of innovation that needs to happen if we all want to be successful here. Then it gets interesting.
And Lorian, you mentioned there's some similarities you've seen with things coming to full circle from going from data centers to the cloud and now back. Kind of why do you think that is, and if you want to comment on that?
Well, I think that, often, people argue about whether decentralization is a goal in and of itself or just a tool to reach certain other goals. But I think there's enough ideological belief in the notion of decentralization, and there's enough desire to avoid the big 3 or 4 cloud providers in entirety that's sort of just driven a drive toward people running their own nodes. I mean, you can run your own node at home if you want. You used to be able to on the big networks, maybe not now, not so smart. But I just think that alone has sort of driven a whole ecosystem and a set of behaviors that are, again, getting people to do it themselves in their own data centers, et cetera, rather than just cloud providers. I think it's good. You raised a good point that there are a couple of networks, or you raised a good point, there are a couple of networks of which are almost exclusively on 1 or 2 cloud providers. So that brings into question whether they're decentralized at all, brings into question whether that matters and anyone cares at the end of the day. Maybe not, unfortunately, but at least it's bringing these issues into the forefront.
I think that's a really important point, though, because the reality is when we started out, decentralization, we have in our product, if you launch a node, we have a decentralization score and that's a sort of algorithm that we calculate based on how many different cloud providers, are there external nodes that are not run on cloud providers, how many nodes in general, et cetera, and we come up with this random metric. And I thought it's a genius selling tool. You know, like I was like, they're going to
No
love
one
it.
cares.
Like no one cares. I mean,
one cares.
the reality is people don't care until they have to go to mainnet and have to fulfill commercial contracts with where they have to, you know, get insurance and offer warranties and liabilities, right? And so my business was a lot harder last year than it is this year, because one of the great things in the crypto winter is that projects get pushed into mainnet. You know, the time is over for blue sky talk. Like you need to actually physically go into production and run something. And then actually you realize actually how hard it is. I mean, there's public networks, you know, and I'm not going to name them, but like one of them, you can't keep the public nodes in sync. Like you can't agree on a block height. You know, like there's networks that are nearly completely unmanageable, you know, and so it's a huge issue the second it becomes really commercial. You know?
Well, delegated proof of stake will be another experiment in whether people care about decentralization, because although the specific governance of every token is different about whether who votes, whether it's the validator, the token holder, but leaving that aside, people, if they care about decentralization, should in theory move their token delegations around to validators in a network to increase decentralization. We'll see if that actually happens. So you have a running experiment, it's liquid, depending on unbonding periods, you can easily move, there's no transaction cost to doing that. So we'll find out again if there's another little way to run that experiment.
Well, yeah, I mean, Bitcoin works because miners are greedy, right? And they want to make money. And in the end, I do agree with you. People, are they going to save money, or is this going to save me time, right? Our kind of stake in the ground is that we do think that these crypto networks will save people money through not necessarily full decentralization, but through an osmosis of people participating and things like that. So, it's a new paradigm, right? So.
And I think you've seen companies like Microsoft see that gap of how much it takes to run efficient, professional kind of services to keep those networks up and running, and they've started to offer their own kind of blockchain as a service. How do you think the role that Amazon and Microsoft and the likes will play out, kind of with the adoption of blockchain? Will they be seen as like collaborators forming partnerships, or are they being threatened to be disrupted? Let's say from now until the next 5 to 6 years.
Yeah, I'll just say something in a minute because I deal with them extensively, obviously. And I mean, they're very different from each other in terms of, Microsoft actually has smart tooling, and it's actually a good, like from a blockchain perspective, I'm like, oh, wow, this is pretty solid. The reason why we exist but it's all in the Microsoft stack, right? So it's like kind of like, yeah, sure, if you want to be not decentralized completely, whereas like you take certain risks, and why wouldn't you? Microsoft is a big trusted company. I mean, the risk is mitigable. But the reality is that it isn't really a blockchain in that sense that it offers you complete trust, right? Like I think if blockchains don't have the ability for complete trust, they're kind of sort of a little irrelevant. And so it's complicated from that perspective. And we've seen them, suck up a lot of companies and businesses and building use cases that they might or might not necessarily need. But I don't want to take away from what they do. Obviously, Microsoft, is a big entity in the space. They run data centers. They have a huge vested interest. But the reality is that in a decentralized data world, what we want to do is we want to break databases open and turn them into dynamic data places where you go and so it goes against the whole principle of what they
see. There's a lot of openness from these companies to kind of be on board with that mission.
I don't know. No.
I think their incentives are aligned to participate in these networks because at the end of the day, people are going to end up running them in their data centers. I mean, even in the open source communities that aren't even blockchain related, AWS, Microsoft, they're super involved. And a lot of the teams within those companies are, awesome teams, and they're looking to contribute and participate in an honest fashion. But at the end of the day, these are large corporations that have incentives to drive profits to their shareholders. And so it's always, a little bit of a misalignment of incentives.
I mean, it's cool to see there's multiple options being provided depending on the needs and requirements of dApp developers or companies building on these blockchain networks, that they can go balance the trade-off between fully decentralized and maybe a more clunky experience versus like a semi-centralized solution. So it's good to see and test out what works over time. I want to change the topic a little bit.
Can I just make one final point, and I'll be really quick. I'm sorry, I always do that.
Go ahead.
Because when we talk about decentralization, just to give Microsoft and those guys a little slide, there's a whole other degree of decentralization, which is like Docker images and stuff. So it goes down to software tooling even. We use software tools that have single points of failure all over the stack. We're just not, right now we don't want to talk about it because we don't know how to deal with it. But that's the reality, there's so much more to be done for this to become true.
Cool. And just in terms of the future, there's been multiple attempts at solving these solutions, and one thing I want to discuss in particular, and free to kind of talk about your own visions, but what do you think about the concept of light nodes? And for anyone in the audience who's not familiar, light nodes are just kind of simple, lightweight, full nodes that people can run on their mobile phones, or that's kind of the vision. What's your opinion on the prevalence of light nodes and their chance to solve these challenges?
Yeah, I mean, the technology is not there yet. I mean, I think if you run a light client on your phone on Ethereum, it's going to kill your battery pretty quickly. Now there are blockchains, though, that are planning with this in mind. Polkadot comes first to mind, where ideally they're actually trying to disintermediate us, quite literally, right? So I think that technology is going to take a while to mature. And in the meantime, we're going to start, there is going to be a need, regardless, for people running these servers, and not just light clients, right? I think running full nodes generally is going to be a really important thing. Mesh networks, you've got Handshake, which is DNS, which is just running a forked Bitcoin node, basically, right? Location with Foam and things like that, you need to have, these full nodes are actually becoming more and more important, right? Whisper on Ethereum, and all these things. So it's really becoming quite important.
Yeah, I totally agree. Light clients are awesome, and it's fantastic to see all the work going into that the past few years. But they're never going to solve every problem, and they're not going to be appropriate for certain classes of applications. At the end of the day, there's going to be trillions of dollars of value flowing through all of these different blockchain networks, and there's a ton of data associated with that, and there's going to need to be beefy infrastructure and full node providers.
Yeah, and I think one thing, the way I see it evolve, is there's also a lot of different types of nodes, right? So there's dozens of different versions of what nodes are. Ultimately, it's like an intelligent API into a decentralized network, right? And so I think what you'll have hierarchies of nodes. And there's companies like, Matt was here earlier, Veriblock, that does proof of proof. Nodes can snapshot and hash into each other and become more and more complex over time, a little bit like the raindrop that kind of goes down a window and sucks up the other drops. And so you can have very light clients that then, secure themselves into, more and more decentralized networks. So I think architecture will get a lot more hierarchical and a lot more dynamic. And you'll have blockchains, or what we call a current blockchain, that might just exist for a nanosecond for one transaction and then dissolve itself and hash itself into something large and public,
It's very interesting. Unfortunately, we're out of time, but I'm sure all the panelists will be available for questions or discussions after the talk. But yeah, a quick round of applause for everyone on the panel. Thank you very much.
Thank you for your time.
That's me.
Still live, careful.
Yeah, exactly.
All right, thank you. That was great. I mean, I've previously worked at Deloitte, and so AWS was definitely a big tool that we used for our consulting project. So looking forward to the future we have with more decentralized cloud networks. On to our next panel for the day. Today we've discussed governance for protocols, funding infrastructures in the long term, but what about the decentralized applications themselves? How are these applications actually using the money, making money, and leveraging the Web3 infrastructure that they're building on top of? In the end, how do these teams actually make decisions that go into their smart contracts? This next panel is here to discuss just that. I'm excited to hear from a panel composed of application builders themselves, as well as fund managers, investors, and journalists. Please welcome our panel on business models for dApps.
Is that good? We on? Yes, excellent. So this is a panel of just me. I'm going to be asking questions to myself. It's going to be very intimate and interactive. It's a new concept. We're just getting mic'd up over there. So my name is Alex McDougall. I'm be moderating this panel. I'm the Chief Investment Officer of something called Bicameral Ventures. And just while we're waiting, I'll give you a little bit of background about what we do. Why this is going to be a really interesting panel is the way that we kind of think about how we're investing is, rather than starting with the blockchain and building all the way up, we think about it as starting with the end user experience and working backwards into what are the components of a tech stack that actually need to be in place to create that end user experience. and an end user experience that makes adoption a natural byproduct rather than a choice, because people aren't necessarily going to choose blockchain. So where that falls into something that we're building today, and come on up, guys, is that there's a lot of different business models that works with, and a lot of different business models at a lot of different parts of the stack, and a lot of different ways to engage end consumers, to engage enterprises, to engage users, to engage the media, and to engage investors. And so we've assembled this wonderful panel here today. I was really trying to find a bunch of shitcoin shillers, but they've all gone back to being real estate agents. I don't know. So we've got this wonderful panel here today of investors, practitioners, consultants, and a really interesting angle is the external media coverage as well. So I've introduced myself. I'll allow the panel to introduce themselves, and we'll dive right into it.
All right, can you hear this? All right. Jay Colby, I'm a co-founder and managing partner of Impact PR. Also work with LDJ Capital, do some advising to different family offices and VCs and folks of that nature, but mostly strategic communications, PR, media relations, and narrative creation is kind of my background.
Hey, Russell Verbeeten, work at, can you hear me? Hello, hello? All right. Russell Verbeeten at Consensus. Been with Consensus for 4 years. Before that, I was part of the Ethereum project, computer engineer originally, in the Toronto startup scene for a few years in the mobile space. And after that, I started looking for the next platform. And it was a good time to do that here in Toronto because, well, Toronto's been really early on a lot of this stuff. Obviously, Ethereum was born here. So, yeah. I've been with Consensus and working on projects in the insurance space, a lot of enterprise projects, quite a few projects in the public dApp space as well.
Hi, I'm Dele Atanda. I forgot that Ethereum was born in Toronto. That's a big claim to fame, isn't it?
Yeah.
Absolutely.
Hey.
So I'm founder and CEO of a company called MetaMe. We're in the personal information management space. So we're creating what we believe is the first self-sovereign AI and what we call smart data marketplace, where we create new forms of information objects that can be owned and traded in the same way that we can do with money. So very much into innovating around models, around commercialization, around data.
I'm John Fiorelli, regional partner with Kinetic. I've been with Kinetic for about 2 years, based in Hong Kong, so on the other side of the planet where it's both warmer and the time zone is very different than this one right now. I would be sleeping. So thanks for the coffee. I started the advisory business at Kinetic about 2 years ago. The intention was to help portfolio companies that we invested in to not only finish their token sales or their equity rounds, but ultimately to build businesses. So in addition to working with Kinetic, I also run an independent advisory to help businesses form their business models, product market fit, biz dev, marketing, and in some cases helping them with secondary fundraising.
Awesome. So we've got a lot of variety of perspectives here, which is exactly what I think we wanted on this panel. Let's start with the topic of decentralization, because originally when blockchains were considered, and let's think in the most recent iteration of 2016, 2017, decentralization was looked at as the feature that will drive adoption. And people will say, okay, well, I don't care about this bad UX. It's decentralized, so let's do it. And that was kind of the prevailing mindset. We're obviously at a bit of a different model now where decentralization needs to be subsumed to what is the actual end benefit to enterprises, to users, and to investors, and what is actually the end benefit of decentralization. Where are we in the story of decentralization? How relevant is it to a business model that you're creating in a new app today? Jay, do you want to start?
Well, I would say from an investor's perspective, I've been through a number of meetings about different things happening with these decentralized products. And right now it feels like it's really too early for most folks, still selling a lot of the kind of the dream and vision. We were just talking in the hallway about, this kind of the perception reality gaps and everything that this space will encounter was preceded by something else, and whatever that something else is, whether it's adoption, use, size, numbers, all that stuff just gets ported into this space. And so right now, I was working on a story with Forbes about some dApps in the kind of crypto lending space, and someone was saying something to the effect of, "Oh wow, that has a lot of downloads," and I'm like, "Well, how many is it?" He's like, 6,000, and I'm like, "Ooh." Okay.
That's a lot.
That's yeah, and so from my brain coming from the Web 1.0 and kind of the 2000s, the numbers are just vastly different. And I think when you walk in a room, the person has the money who's coming out of those generations. That's a tough sell. You have to sell kind of the future and the dream, and they just ask you for things, unfortunately, that probably don't make sense, but it's framed by their experience and the numbers that they're used to seeing. And then when you come in, and those are vastly different. The dream and the vision doesn't usually usurp numbers. We're very numbers-driven folks. The numbers are what the numbers are, and to look past, I think, is the biggest challenge. And right now, that seems to be the hurdle. You get into a room with the wrong people, and you're like, well, wait a minute, I want to see millions of downloads, and that's just not where we are right now.
Yeah, I mean, I guess you could. I mean, I agree generally with the premise of the question, but there is also, it seems like, elements of the crypto community that are now starting to become more mainstream. So this idea of encrypted data and data privacy, I mean, I'm sure there were lots of communities where that was being spoken of, but it was definitely being spoken of within like the blockchain community 5 or 6 years ago. And now that seems to be coming into like the more mainstream consciousness. People are starting to become aware of the importance of, you might call it decentralization. So that's maybe an interesting anecdote about just larger trends in decentralization and people starting to care about it as such.
Yeah, no, that's an interesting point, because I think some of that is tied into realizing the downsides that centralization creates. And I think that is something that we're very bad at, and Web 2.0 has really made a seamless experience where a lot of those downsides are really hidden. So as much as it is about realizing the upsides of decentralization, there's also an ability to make the downsides of centralization more obvious and drive adoption that way as well. But Dele?
Yeah, so I think there's a danger. We get very zealous about decentralization, and of course all of us believe in the future is decentralized in many senses, but I think there's a set of tools that we have to use in different ways, in a combination of different ways to achieve the right outcomes. So when I look at privacy, for example, you get into this space and everyone goes, oh, is your chain permissionless? Is it completely decentralized? And you've got to see where that's relevant and where it's not relevant. So to take an extreme example, when we talk about self-sovereignty, what that really means is self-centralization. I don't want a decentralized network of me. I want to be at the center of the network of me. And if so, really, anything that's proposing anything other than that, yes, I might have distributed storage of my data for security, but ultimately I want a logical, centralized network for me. That's what self-sovereignty really means. But if I am a self-sovereign entity in a network, then that network becomes decentralized because we're all self-sovereign entities in that. So it's really important to understand where we need centralization and decentralization, and to use these things in a combined way to get the outcomes we want.
It's funny, you bring up the centralization of me, right? So when we talk about centralization, what we're really talking about is control.
Absolutely.
Right. So what do I have control over? What can others have access to that they then have some implicit control? So I think that's the real question, right? And decentralization is not really an end in and of itself. It's the benefits that flow from that. So for example, social media being shut down in Sri Lanka during the recent terrorist attacks. Everybody has different opinions on what the benefits were of doing that. But if someone felt that they needed to have access to those networks, decentralization would allow them to have, uncensored access, right? And so a fair question is, in that case, I want control over access to my networks, right? So that decentralization is directly providing a benefit, a real benefit that I can actually quantify. But right now, at least with some of the projects that I'm advising, their problem right now is much more commercial. In some cases, the conversation they're having is a B to B to C biz dev sales channel development, where they're trying to help, maybe this is something you're dealing with, in terms of selling their infrastructure to a Web2 company who will then make that a part of a solution where decentralization to an end user is not actually the benefit, right? So what is the benefit? And actually, maybe this is my question posed to the rest of the panel, if I could play part moderator with you. What are the benefits to the end users that we should anticipate where decentralization proves the case and makes it interesting? That's a question that
I'm glad you did that, because we do want Alex to answer some questions.
Go, Alex.
So, I mean, the benefits to an end user of a decentralized world, I think it ends up being where you can get the same benefits that we can today in terms of customization, tailored experiences, and all of the things that we sort of rely on these large analytics and trust proxying companies like Google and Facebook to provide for us today, in a way where we know that that experience is being tailored just for us in a closed loop. And so I think of that when I think about if I'm an end user that actually is looking at where my data is going, I don't actually mind sharing my data with somebody who's actually using it to tailor an experience. And we'll get into one of my later questions here potentially and throw it back to you guys. But that was the original Google model, or the original Facebook model, was provide a service, get data, use that data to make a better service for that individual person. And then when there was no monetization in that, when there was no willingness to pay on the consumer behalf, and essentially people realized what the value of data was and that there would be corporations and researchers and everybody else willing to pay, then that business model became, okay, well, let's actually use that data to convince people to do things that makes their data more valuable to these people in the background who are willing to pay. So I find the benefit of a decentralized world. And what I'm interested in asking you guys is, what's the business model now that closes that loop but deals with the fact that consumers aren't still willing to pay, really, from an end status? And whether it's the blockchain ability to pay in value by being able to perform actions where you receive some kind of digital good that can be exchanged for privacy or something along those lines, there's a whole bunch of interesting business models that come out of this ability to have immutable self-validated data, and to have the ability to have microtransactions and the ability to have smart contracts that real-time incent data. What are your guys' thoughts on what the business models are that come out of that?
So before we get into that business models, I did want to just come back to the point about what's the value to the consumer with decentralization, because I think it's a really essential point. And there's two elements to it. One element to it is that, I will answer it explicitly, but before I'll just say, the one element is that the example that comes to mind is, there's a story in England when electricity was first created. And there was a lady who apparently created the first house with electricity. And everyone said to her, why are you going to this extent to get electric lights in your house? I mean, aren't lanterns good enough? And the point was that people couldn't see all that was coming with electricity at the time because they were only comparing it to lanterns. So I think there's an element of that when we come to the value of decentralization when it comes to consumers.
Almost like we don't know what the value of consent is.
Yeah.
Because we haven't had a chance to practice it.
Exactly.
Exactly. You remind me of a great talk that Jeff Bezos, who is the richest man in the world, was giving a talk in 2002 when he was just nobody. He was just some internet CEO guy. And he was making the electricity analogy. It's a really good one. I totally agree with that.
If only you knew.
It's foundational infrastructure like the internet itself, and it was hard to appreciate for that reason. Yeah.
Exactly. But I will say, though, I think just to build on Alex's point earlier, I think the way we win is that what decentralization does is fundamentally a better experience for consumers than what we can get through centralized services.
How so?
So a classic example for me would be the idea of self-sovereign AI. Now, the way that AI works at the moment is that it's effectively a common denominator. So a centralized service like Alexa, Siri, or Google is always going to default to the core common denominator. It's never going to deal well with edge use cases. There's no logic that would support that. But if you had a self-sovereign AI service, on the other hand, which was dedicated to you and your data, then it's always going to outperform a centralized service. And there's no way that a centralized service will be able to achieve that level of personalization and individuality at scale. So that's the kind of model I think.
So it's
Well,
kind of like
hopefully you wouldn't have to like unplug your Alexa, you know, when,
Well,
when your friends were coming over or something.
You'd have it manage Alexa for you.
I think another part of that conversation too, at least with adoption and use, is that I think we have to get a better understanding of the trickle-down value, just the financials, right? So if you're taking all these, this is a big thing that you're always talking about, these trust mechanisms out, you know, all that overhead to secure everything, like does that trickle down to the end user somehow, right? And if you're dealing with your data, you know, I've worked with some data sovereignty companies, and right now the numbers are pretty small, you know, in the current data models, like, you know, you're talking a couple $100 a year in certain channels is what you're gonna get back. And maybe if you just want control, that's great. Some people they want money, maybe they're money and control. But I do think one thing that's missing is like, getting back to the value of that, like, you know, is that data that you're controlling somehow gonna be worth more, not only for your experience, but to other people who wanna buy it. But I think that's missed in some of this too, is that, I mean, where are all those billions and billions and billions of dollars going that are kind of controlling the centralized entities, is that when that flows back into the system, you know, what does that do to the underlying economics of everything from the end user to the businesses that are now, you know, running on that system? Because there's a lot of really broken models. I've worked for a long time in ad tech, PR, and that's a mess. You know, we're 15, 20 years into trying to monetize content on a digital screen, and it's a mess. And, you know, it still survives the same way TV did with the 50% waste rule. You're still paying for 50% of that audience. It's just not in front of the TV. And digital promised not to do that, but it's still like 30, 40%. When you start figuring out viewability and frauds and bots, all that kind of stuff, you're still paying 34% of your money, and digital advertising is being wasted. And so what happens when you start to like clean up all that waste? I think some of those models actually just are not, they can't continue.
You can almost look at a big category of blockchain use cases as fixing broken internet.
Right.
Broken internet platforms.
But I think what I always feel like is missed is that trickle-down effect. And I think because I think that's like the people who just need the really, really simplified version of the story are not the ones who are talking about this stuff yet. And at some point, that really simple story has to be like, is it control? Is it trust, security, monetization? You know, those really simple, basic lizard brain things. I just feel like that's still kind of being missed in a lot of the conversation, and I think it'll be really interesting to see if you can refine things in a way where that value that, you know, when you were talking about all the things Google did, in my mind it was like make $1 billion. You know, it was like somewhere in there you've missed that part in the chain of things that they were doing.
Many billions of dollars.
Many billions of dollars. But yeah, I think that really, really simplified message is still out there. And I think some of it will come, what you're alluding to, Dele, like, and I always tell people when we're doing comms for them that there's someone who's probably gonna come along and take their platform and do something with it that they never anticipated that's really amazing. And that always happens in technology. And I think hopefully that'll happen with this. There's something out there that somebody's gonna build something, but someone's gonna do something really amazing with what they built. We just don't know what that's gonna be yet.
And I mean, I think one of your questions, I think we're probably getting close to the end, but this is a good segue, is like there are all these foundational services, blockchain services that are going to enable these applications. It's like I always think about blockchain infrastructure as repurposable and to particular users' needs. So if we have identity and we've got supply chain and we've got X, Y, and Z, then the next entrepreneur can come around and she can create something on top of that infrastructure in a way that's really, in a way that perhaps wasn't possible before these trends
You're
of
just thinking
decentralization.
from a ground up growing up thinking that you have control of these things that none of us grew up with control over, right? You're gonna go places that we just can't go.
Yeah.
And one of my biggest disconnects was early on with self-sovereign data. People were like, "Oh, we're gonna do all these things," and I'm like, "Wow, that's never worked." Like people can't even like put themselves on the do not call list, you know, and they don't like getting phone calls, but you know, the simple stuff that no one ever does, and like, you know, they're going to control their data. And then actually a fellow from Consensus changed my mind about that. Your design chef, Jose Caballe.
Oh, nice.
Jose's still there. He's awesome.
Oh,
But he's like, but when you grow up doing that, you'll do it really well, right? When you're sovereign from day one and you control your data, you'll grow up and use it in a way that's much more efficient, much more powerful, and in ways that you can't envision as someone who's never done it. And that's kind of when I think that's where the change will come from.
Because you'll expect it.
Yeah.
You'll demand it.
Yeah,
because it's always been that way.
it'll be just native. It's just in what you do, and then you will take that and do something amazing with it that, again, people who've traded their data for platform access their whole lives will never envision.
Yeah, absolutely, and that does build on one of the core concepts that we talked about on our initial call, which was the electricity idea of people can't appreciate the fundamental end goal of it. Same with the early stages of the internet. When you went in and pitched the internet in 1990, people said, "Oh, you mean email? Well, we're going to send 1 million emails, or 5 million emails, or 10 million emails." And that's sort of where we're at with blockchain right now. It's like, oh, you mean, okay, well, we can take 5% out of our cost of goods sold, or we can eliminate a couple $1 billion in remittances. But really, I think what we're all talking about, and I'd love for you guys to comment a little bit more on this, is we're creating the fundamental building blocks for business models that we can't comprehend today. And so a lot of the decentralized versions of business models that we have today are admittedly version 0.1 of something in the future. And I'm not sure 100% that people even know exactly what those are in the future, but that people are, all we can sort of do is solve for what are the building blocks. And so maybe let's spend a little bit of time on specifically what are some of those building blocks that are being put in place today. Do you want to start with you, John?
Sure. I'd love to start with how to make the user experience better. And if I want to navigate that censorship-resistant content, then I need an easy way to find it on a browser, right? So Ethereum naming services, or just name, BNS, right? We need BNS on all blockchains to the point where it's native to every browser, not only Opera and Brave and what have you, or I don't have to add a plugin. That would be great. I would love it so that I would never have to think about private key management. I'd want it to be as simple as possible, because otherwise my grandma is not going to use it. And I want grandma to use this stuff, right? How many of you have grandmothers? It was almost rhetorical, but so almost. I think it's important that every user should have access to this type of technology and to have access to self-sovereignty and the ability to be, the right to be ephemeral, right? Not merely to be deleted, but to have that true control. And so I think BNS is a big part of it. I also think, to your point about identity, we also need forms of authentication that are easy, that are secure, that I don't have to think about my SIM getting swapped. I don't have to think about losing my crypto. Like, this kind of stuff needs to be simple. So that's kind of where my focus is in terms of infrastructure.
Yeah, I'm interesting. I wrote a post a while ago. I got tired of the whole crypto versus blockchain narrative, and it was called "Crypto is the User Interface of Blockchain." And my kind of thesis there was that, well, if you look at UX, UI, really Web 2.0 is crushing that. It's with VR, voice, AR, that's all Web 2.0. There's really nothing decentralized in there. So what I fundamentally believe are the most essential building blocks are decentralized data, decentralized money. Smart money, smart data. And I think, programmable money, programmable data, these fundamentally are new asset classes that change everything. And I agree, we need to bake in simplicity, intuitiveness, and usability into that, but we really can learn the best use cases there from the Web 2.0 world. Web 3.0 is an evolution, it's an upgrade of 2.0. It's not a recreation of the internet in that sense.
Thank goodness.
Absolutely, and I think Vitalik is a classic example of somebody creates something brilliant, blockchain, and then someone comes along with smart contracts. Look how transformational that is, effectively. So, but I think the fundamental piece is decentralized, smart data, smart money. These are really the building blocks of the future, and upon that, all sorts of new possibilities come into play.
Yeah, I think that like crypto is the user interface to blockchain. That's kind of cool. Yeah, it's also like, we do a lot of work in the enterprise space at Consensus, in addition to the public network. And there you see like consortium chain business models that are interesting. And within those, like you can, there are obviously some of the crypto economics are much simpler or at times non-existent, but you said like, you've got notions of identity, multiple actors, governance, software standards is a big one. And I think so, I guess it's just an interesting point to this conversation that we can see kind of some of these production-ready platforms that are maybe more about efficiency gains in the enterprise space, incorporating in more in simpler formats some of the key elements of that will apply to the blockchain writ large.
I'm good. You really got it. I think we're running out of time.
Yeah, we got 23 minutes and 50 seconds of the next panel to talk. Awesome. Thanks so much, guys. Really appreciate it. Round of applause for our panelists.
Good job, guys. Thanks, guys.
We'll all be around for a while, so feel free to come up and ask us questions.
All right, thank you. And special thank you to our moderators, Alex and John. Next up, we have Gregory Marcoux. Gregory is partner and VP engineering at ChainSafe Systems, and his focus has been on ensuring interoperability amongst different blockchains and ensuring the usability of such applications. So great segue from our last panel. He's been working towards accessibility solutions to provide ease of use to everyone and anyone. Gregory also leads ChainSafe's Ethereum 2.0 efforts and is a core contributor to the Ethereum ecosystem. In this capacity, he's likely in a select group of people worldwide with practical experience scaling on an open source blockchain network that is also public. He's here today to discuss his experience and lessons learned as a contributor to a decentralized organization and a decentralized future. Welcome, Gregory.
Test. Oh, hey. Yeah, thanks for that intro. That was a lot. So today I'm going to be talking. So my talk today is about generally just an open source, basically scaling open source, and how we can look at different approaches to actually getting more open source contributions and expanding the network. And we're going to be doing this by. So I'm going to be taking a talk that I did basically about how cross-chain collaboration is building ETH2 and kind of bring this as a narrative to show you how we can grow open source contributions within other ecosystems and other chains. This is the switch, right? Yeah, cool. My name's Greg. I'm at ChainSafe Systems. And basically, as said, I'm the VP of engineering there, and I do a lot of the development on ETH2, and a little bit of, I help out the Polkadot team a little bit, like our Polkadot initiative as well. Nope, that didn't work. There we go. Just quick on us, who is ChainSafe? We're a local Toronto-based blockchain research and development firm. Out of basically working on infrastructure for Web 3.0, so just blockchain in general. And we're we have this philosophy that we're chain agnostic. I don't really care what chain you are. I'll build on you as long as I believe in the technology of it and I believe in the morals and the philosophies of it. That's why we work on ETH2. We have a client in ETH2, and we work on a client in Polkadot, and we have a third one that's just private as of now, but hopefully we'll be announced that soon. I just also want to give a cool shout out. This building is actually where ChainSafe first came to be. The original meetings for it happened downstairs on the first floor, so it's kind of nice to be back. It's kind of a little sweet treat. But let's dive in. This doesn't work. Okay, so as I've already said, we basically we're doing ETH 2.0, Polkadot runtime. We also built the Goerli testnet. So those of you familiar with Kovan, it's now going to be deprecated in the next month or so in favor of Goerli. It's just a cross-client proof of authority testnet. And I'm going to be using this as a really good example later on. And we also work a lot in interoperability, bridging, and that's kind of what got us into client work. So let's get into the talk. Let's look at how cross-chain collaboration is actually going to benefit us and how, addressing some of the big elephants in the room and why there's barriers to entry in cross-chain collaboration will get us there. So just a quick on ETH2, just to understand the ecosystem, we have 3 phases that we're building, and we're only at the first in phase 0. That should hopefully go production in mainnet roughly at the end of 2019. The next phase in 2020, and phase 2 thereon after. It's kind of hard to give an estimate over 6 months, I'll be like super honest, so especially with this type of work, but we're looking hopefully late 2020, early 2021. And basically, there's a lot of moving components. We've got a lot of contributors as well. I mean, there's like 9 to 11 different implementations going. We have about 54 contributors contributing to the spec at any given day, which is a lot, especially because specifications move fast. We also, have about 183, but this is missing EWASM, the EWASM team, individual unique people working on ETH 2.0. And this is just ETH 2.0 alone, and the stats get really interesting when you start to see that they're actually from other chains, and a lot of people work on other projects. Okay, there we go. Fact check, don't need to go with that. So this is what I want to get to. So we have some important components in ETH 2. We've got our beacon chain and validator. These are our main clients. So you can think of them sort of as like Geth, Parity, and then the validators like the miner. We've got shards. We have EWASM, BLS signatures, libp2p, wire protocol, and simple serialize. So we have a lot of moving parts, and these are really important dependencies. And basically, if we look at libp2p, this is a really good example. libp2p is a networking tool. It was built by Protocol Labs for IPFS. They've basically built and abstracted away their networking protocol that's on IPFS, and it's being used at this point by many blockchains. We're talking, Polkadot's using it, ETH 2.0 is using it. I don't think Cosmos is, but there's talks like on some forums that they might. Dfinity's using it. Basically, everybody's using libp2p. And currently what it looks like is they're a very small team. Right now, the Go implementation is mainly written by an ETH2 team called Prismatic Labs, and they're maintaining it. The spec for it is actually off of the Go implementation, so they're updating the spec according to the Go implementation. It's kind of like a backwards concept. And that's kind of due to underfunding, really. The JavaScript version is being fully built by us and maintained at this point, some subsets of it at least. So we're working with Protocol Labs to get that one. The Rust implementation is done by Parity. So as you can see, like ETH2 is like really a big contributor here to actually building out libp2p and making sure that its functionality is like fully fledged, because there's a lot of missing components going on. So we're already starting to see a lot of teams collaborating just on the same tool sets. BLS signatures. So BLS is a scheme for creating private keys, signing for private keys, signing for an aggregate of private keys, and verifying these keys. We use it to basically prove that you own your Ether, on ETH 2.0. And it's not a new scheme. There's a couple of chains also looking into it, but it comes and goes on who's actually, the implementations are kind of, it's been around for a while. It's a cryptography scheme that's been here. It's been tried and tested. So That's BLS. WASM. WASM is a really big important component for us because in ETH2, basically we're swapping out our EVM and putting in eWASM. eWASM is essentially, WASM is WebAssembly, for those that don't know. WebAssembly is simply just a way for us to take like C++ code, for instance, put it into WASM, and then we can run it in the browser as an example of what we can do. So it basically turns code into like into this like language that's unified that any other language can then go and read and execute upon. So we're building our EVM in that, which is why we're calling it eWASM, basically so that we can, it's faster, it's more efficient, and it's plug and playable essentially. It'll make life really easy for implementation teams. And the WASM specification is not like fully fledged out, but you know, we're working with them. Am I ahead? Oh wow, I'm like moving really ahead, guys. Yeah, all right. So, really brief intro because I don't want to take too much time. This isn't an ETH2 talk. But the big problem that we're going to start seeing here is a behavioral problem that's existed for many years. Like many years, I'm going to start, and basically it's part of human instinct. And that's maximalism and tribalism. And these are two really important things I'm going to talk about, and why these two factors are actually give a negative connotation to collaboration. They're preventing cross-chain collaboration, they're preventing collaboration in general, and they're moving people out of ecosystems. It's not really, this isn't like a solvable problem either today. I don't think I'm going to tell you that, but what I'm going to tell you is I'm going to address the issues because I think a lot of people really don't see this day to day. So, the common debate, you know, is like, is blockchain A designed to replace blockchain B? Lots of people say this, you know, is Polkadot going to go and replace Ethereum? Is Cosmos going to go and replace Polkadot, vice versa? Obviously, this is like a valid debate. I mean, lots of people want to talk about it because, you know, competition to many seems terrible, which is kind of ironic because, you know, we're all about like kind of getting rid of like getting rid of intermediaries and like, you know, we need like lots of things, but we have a lot of people that kind of go, no, we need to like absolutely take down this chain. You know, my chain is the only chain that should exist. And that's fine. You can totally believe in your chain. I'm not going to tell you what to do, but it adds a negative effect on the developer experience, especially for a lot of ecosystems. So for instance, like this type of attitude, what it ends up doing is the developers, you don't have developers that speak out. So for instance, in the Ethereum community very recently, we had a member, a very core member that was in charge of organizing basically all our hard forks and soft forks, basically get removed from the community simply because he voiced his own opinion, even though he was still very dedicated to our chain, to Ethereum. And what that did was it caused chaos, mayhem. Now there's very few developers, like core developers, that are willing to actually speak their mind. And what this means is that we're less inhibited to go and talk to other people and like collaborate and say, hey, I'm working with, you know, Polkadot to go and better understand how they do Merkle tries. If you go and publicly say that on Twitter, it's going to look like Polkadot, people will start screaming, people will say, hey, Polkadot's going to steal our dev. You know, they're trying to steal our resources, whatever it be. So I want to try and take that and spin it another way to kind of show that that's not actually what's happening. And what's happening is we're seeing cross-chain collaboration. We're seeing very early cases of it, in which what we're going to end up doing is we're going to end up bringing lots of people to work on similar projects, and that way we have higher contribution counts instead of siloing resources across multiple networks. And that's a big problem as well, right? By not collaborating, we're siloing all of our resources across multiple networks, and then we're duplicating efforts, duplicating work. And you know, we're not progressing here. This is decentralization. We should be working together. We shouldn't be, you know, fighting each other in like this like whole capitalistic like view of, you know, competition. Like competition is healthy. libp2p. So I touched on this earlier. I actually kind of alluded to it already. You know, as I said, like ETH2, working in ETH2, we're building a lot of like core infrastructure for the libp2p team. But the other thing is, you know, I talked about how we have a Polkadot client. Our Polkadot clients are in Go. And we've actually been contributing to the Go version of libp2p as well. So now we're helping out the JavaScript side, we're helping out the Go side, and an ETH2 client is also helping out the Go side from Prismatic. And what you're seeing now is this is like a little hint at what cross-chain collaboration can look like. Filecoin also uses libp2p. Technically, it's part of the Protocol Labs team, but this is just an example of like what could happen, right? We have 2, 3 chains now actively developing on the same stack, sharing development resources, and what this does is it reduces the cost for all chains, right? Now, we don't have to overly fund because one initiative, because other chains are all using it together. And it brings up the total contribution count. We have more people looking at networking. Networking is a tough thing. Not many people know about it. My other example is going to be BLS. This is a really unique one. So up until about 2 months ago, in Stanford, 3 months ago, the Dfinity team announced that they had this really cool BLS aggregation scheme. Basically allows you to take like a bunch of public keys and verify that the bunch of signatures, and verify that like all these signatures are valid, all in one big go, which like takes down computation time. Up until about 2 months ago, almost every team at ETH 2.0, for instance, was using this library called Harumi. It was a BLS library. This library is written, the author is an employee of Dfinity. Dfinity actually actively funds this library. So here we are, we've got people saying, we got to be all Ethereum, like gung-ho Ethereum, yet they don't even realize the underlying technology is completely built by Dfinity. The underlying technology that they're like, got to keep my private key secure, they're generating their private key, was totally written and funded by Dfinity, right? So this is like the cross-chain collaboration I'm talking about, right? We're using theirs, we're actually contributing a little bit back to it to try and we're finding issues in their implementation, which is helping, grow the ecosystem. I touched on WASM earlier. This is actually like an even wider cross-chain, more than just cross-chain. WASM in general needs help. It's like very in its infancy. It's still, it works really well, but there's always bugs. Nothing's ever perfect. And with us building out eWASM, we're building out an incredible solution here that then contributes back to the WASM team. And every other chain's using WASM at this point. We're seeing, Polkadot, Ethereum, Near Protocol, I think Aeon also uses WASM. And we're all using WASM here, so we all need to use the same specification of WASM, the all same compilers, the same transpose, whatever it is that you're using. And we're collaborating together on it. And it's good. Everyone's happy. This maximalist behavior, this tribalism that like our chain is the only one going to succeed and I'm going to fund what I want is kind of crazy because we're using everybody else's stuff. So for example, this is a package JSON for those that aren't aware. It's for node projects. It just outlines kind of like the packages that you're using. This is for our client in ETH 2.0. If you look real closely, we use Polkadot under the hood for some of our crypto pairings, pairing libraries. We also use BLGR. This is like the fun part of my presentation. It's a Bitcoin library. We use BLGR is written by a group of people called Bcoin, or Handshake, if you might know that. The reason we use it, all their libraries are zero dependencies. They have zero dependencies, and if anybody writes a Node or JavaScript, you'll know that it's like popping pills with NPM. It's just like NPM install, like 1, 2, 3, 4, 5, and next thing you know, your dependency tree is like 500 dependencies deep after you go like 3 stacks down. And they write zero dependencies, so I'm like, hey, that's a perfect use case. I'm gonna use them because it makes sense, and they're a Bitcoin team. I don't care. Why should we care? Why do we have to care that we're using other teams' technology, and why can't we contribute back to it, right? They're doing good things, we're doing good things, there's no need to duplicate effort here. If we can actually collaborate, we're saving money, we're saving time, and we can move faster. Yesterday, I think I touched a bit on this, right? Like, I think we move too slow, and to move faster, we need to start collaborating to literally do less work. If we do less work in this space, we'll be able to move faster, advance this technology, and like fix a lot of the UX problems that we have. Because like a lot of it is down to UX. And by not collaborating with people, we're just isolating ourselves, putting ourselves in a box and saying, we'll deal with it ourselves, but we'll just hinder everything else and take 2 times as long. Now, those are like great examples of just like on the development side. I want to talk about funding and something very unique. So as I talked about, Goerli was basically the first cross-client proof of authority testnet. Every other proof of authority testnet on Ethereum was siloed by clients. So Parity had their own version, Geth had their own version, they didn't talk to each other. At ETH Berlin, we hacked on it and basically allowed them to talk to each other and built Goerli. Goerli, was awesome. Like, we built it, the community ended up taking it over. We basically just managed it and helped do a little bit of things here and there. But there was a problem. We needed to pay people. And we needed people to pay for it. We couldn't get, we tried funding it as much as we could. We couldn't get enough grants. And then these guys came along. The Ethereum Classic Cooperative. Ethereum Classic's like the original Ethereum chain, and then we forked it and called ourselves like the main chain. They're the classic one. They paid for the development of Goerli, not because they were being nice, not because they were kind, but because they knew they also needed a POA testnet, and they said, we'll fund it for Ethereum mainnet as long as you guys just make some backward compatibility support for Ethereum Classic. And we did. And then the EF gave us money after, a couple months later. So this is a testament to what I think cross-chain collaboration should look like. This is how we can scale open source. It's from other teams working together, other funds working together, other chains working together saying, hey, I need that tech. I need it expedited a little bit faster. We could really use it today. We'll help fund this initiative to get it done. And as I said, Ethereum, the Ethereum Classic Cooperative, what they did, I think is a testament to what we should look for in the future when trying to collaborate, because they funded Goerli well before anybody from the current Ethereum mainnet funded anything to do with it. And now we've got a cross-client testnet working on 2 different chains and supported very full out. So, yeah, I'm running out of time. Apparently I'm faster than I thought, slower than I thought. So yeah, just like a final note, we need to remember I'm super passionate about Ethereum. I love Ethereum. I won't tell you, I won't say anything otherwise. But, it's the people building the infrastructure that have the hardest time when people are voicing these views. When people voice these views of maximalism and tribalism, it really hinders that, because they're the ones trying to make key decisions on how to progress everything forward. And then by people going out and raging at them, calling them traitors, calling them, trying to annex them from the community doesn't help our own development, because it puts us back. It makes us reserved. We don't talk. People don't talk as much. They don't want to say their actual opinions on a decision, because they know all they can worry is maybe their job's on the line now. Being open about other chains will only help. You can still your chain's the best, but let's get rid of this tribalist attitude. Let's get rid of the attitude that we shouldn't be dealing with anyone else, because all it's going to do is we're going to have no chains. Assuming we don't live in a multi-chain a multi-chain world is a little bit foolish. We don't have one social media. We've got 10 different forms of the same one, and we all use them. You still use Twitter, you still use Facebook. You can post statuses on both. To assume we can't have more than one chain is a little crazy, and to assume that we can't collaborate with all of them is also a little absurd. So, let's take a decentralized attitude toward it and actually start looking at how we can talk to one another. Thank you. If you have any questions, I have 5 minutes on the clock. I have 4:20 minutes on the clock. Literally. Okay, no worries. Thanks, guys.
Thank you, Gregory. That actually reminded me of a quote, and I'm going to probably butcher it, but I think it goes along the lines of, we will get farther and faster if we collaborate rather than compete with each other. That was totally a butcher of the quote, but you get the gist. So next up, I'd like to invite Ali Sharif to the stage. Ali is a core developer at the Aeon Foundation. As a researcher, he spends most of his time looking at how open source public blockchains should and will evolve. Ali will explore the future of blockchains and where the research is taking us. Welcome, Ali.
everybody. I'm Ali. I work at the Aon Foundation. I spend most of my time doing research. And so you'll get to hear about sort of the ideas that I work on. This is not a technical talk. This is mostly a talk about philosophy and sort of the framework that we use to think about evolving blockchains. So is research just an excuse to not do any work? I'm going to try to convince you it's not. And I'm going to kind of do the thing that I do for a living. For the next 30 minutes, we'll talk about one definition. Like, the whole talk is about one definition, right? So theoretical computer science research, the way it works is you conjecture something exists, right? So I can create an algorithm that can run in some number of steps, right? And I come with a precise definition for that conjecture, and then I try to realize it using existing technology, right? And then I go back and forth, either tweaking the definition or tweaking the conjecture. So a lot of what we're going to talk about, came from this guy, right? So the best way to understand the future is to look at the past. So this guy in 2013 goes on stage at a Bitcoin conference and presents a definition that looks like this, right? He claims that, we can realize a magic computer, right? Now, if you tell this to a theoretical computer scientist, they'll laugh you out of the room. But when you present this at a Bitcoin conference, you can raise millions of dollars to try to realize this. So let's try to break this down, right? Blockchain, he conjectured, is a magic computer. Anyone can upload programs to it, leave those programs to self-execute. The state of the program is publicly visible. The magic computer is crypto-economically secure, and the computer and the programs on it will continue to execute as the protocol specifies, right? So this is just a definition, simplified, has the same elements, but just, condensed. And you'll see this definition on almost every slide. I wasn't kidding when we're going to talk about a definition. This is all we're going to talk about. So notice this definition does not talk about any use case. It does not talk about currency, ledger, doesn't talk about implementation details, consensus VM. None of that thing is in there. It just talks about this magic computer, right? So, but blockchains, currencies, how is this a blockchain? Well, imagine writing a program on this magic computer that is a currency program, right? So you have accounts and you have balances, right? And you increment the balances, and then you just all assume that that's currency and that's currency, right? And so you can use this magic computer to implement currency, right? And all this definition is saying that imagine there's this computer that all of us can log into and access and run programs on, right? But isn't that the cloud, right? Because people do that on the cloud. People have computers owned by Amazon, and we run programs on it. And when you visit a website, you download those programs in your browser, and your browser executes them, right? So what's so different about this computer, this magic computer that's not the cloud? Well, this computer has some special properties, right? So the properties that we want is that once the application is deployed, it's guaranteed to run exactly the same way that the protocol specifies, right? So if the protocol has censorship resistance, no one can censor your application. Your application will keep running as it was intended to, right? And the application convinced their users of their honesty since the logic is publicly available, right? So these are some special properties on top of the properties you already get from the cloud, like availability and the fact that it keeps running and has uptime, etc. Right? So, this is sort of the concept, right, of the statement when people say it's the blockchain that's exciting, not the currency. This is kind of what they have in mind, right? This idea that, there's this magic computer that we can realize somehow, right? That can implement currency, but that can also implement any other program that you can imagine, and it's a public good and everyone can use it, right? And obviously, there's some concerns that we're glossing over, like how do we pay for this, but let's not worry about that. Okay. So then, so we had a definition. Can we realize it? Well, obviously we can, right? We have Ethereum and Aeon and all these other blockchains which look exactly like this, functionally, which is we have programs that are uploaded, and then when you want to call functions in that program, you create transactions, right? You send those transactions to a miner, miner collates them into a block gets sent to the P2P network, the P2P network comes to a consensus on the state and then publishes a block, and that block is final, right? So I'm gonna assume that you're familiar with this construction, and well, yay, hooray, let's go home, right? We're done. We realized our definition with an instantiation, right? Not so fast, right? That instantiation has been around for half a decade, and yet I'm still paying for my sandwich with dollars, right? What's going on? Where are all the blockchains hiding? So this is a sentiment that we hear all the time, like blockchain is useless, like there's a lot of things I can't do with it, or the things that I can do with it, I can probably do it better on the cloud, right? So what's going on, right? Like they're usually right, like they're not wrong. When they say that, they're particularly smart people who are saying these things, so what's going on, right? Well, like, we're missing a few things, right? So the instantiation that we have of the definition is not perfect. It's missing a few things. It's missing particularly scalability and privacy. If you're familiar with the space, you're at this conference, you go to other conferences, you hear about these two things all the time, scalability and privacy, right? So what do people mean by scalability? With scalability, I want to do more powerful computations and I want to do more of them, right? So I have this magic computer. Right now, I can only do so many computations per unit time, and they can only be so powerful, right? But privacy, well, you look at the definition, right? It kind of has the states of every program are publicly visible, right? Like privacy is, lack of privacy is baked right into the definition. So, there's some fixing we have to do here, and we'll kind of spend the rest of the time fixing these things. So I'm not going to beat a dead horse and talk about specific ways that we do this, but I'll go over high-level ideas of why is it so difficult? Why don't we have this today? And what are some ways that we're, as an industry, kind of going about this? Okay, so if you remember from the slide where we talked about the instantiation, we had this P2P network, right? It's a decentralized protocol, and the adage goes that decentralized protocols are scalable, right? But that's not really true, right? The thing that we need to understand is the nature of the scalability is important, right? So cloud is decentralized, and the way Google achieves scale is they have thousands of computers doing the same computation, except the way they achieve scale is they have a load balancer and they send your data to different computers, right? So if everyone in this room tried to access a program, some of you are going to be directed to some partition of the network, and other people are going to be sent to other parts of the network, right? BitTorrent, similar thing, right? The more people are on the BitTorrent network, the more disk space we have and the more capacity the network has. And so in this distributed decentralization, we're splitting up the data, right? And we're splitting up the computation between computers. Versus in the blockchain, what we've done is we've replicated the work, right? So every node processes every transaction, and every node is maintaining the state, right? So when a distributed, when you have the distributed decentralization, the network gets stronger the more nodes you add. But in the replicated case, or in the blockchain case, you can never be more powerful than the processing power of a single node, right, to the first order, right? There's nuances to this, but to the first order, that's more or less correct, right? And this is not me saying it, this is Vitalik saying it, right? So it must carry some weight. So this is sort of another picture to understand this concept of replicated versus distributed, right? So replicated, everyone's doing the same thing, they're the same color. And in the distributed case, they're all different colors, right? So, okay, so we've got this blockchain that it exists today, the current instantiation. It's a replicated instantiation. So how do we fix it? How do we scale it, right? So these are things that we've tried as an industry to try to solve this problem. We've had, faster block times, bigger blocks, and all that's trying to do is, point number one, we're just trying to fit more computations per block, right? So you can try to do that, try to make this more powerful, right? Now, one of the problems with this is that, okay, so we can try to do this So we can try to fit more things per block. There's been ideas about, taking computations off-chain and publishing proofs that the computations happen correctly, and we're going to see some of that later on, right? So that's one way of doing it. The other way is, increase each one of those computers, right? So this is kind of the approach that EOS has taken, which is say, okay, we're going to have 20 super powerful computers, and they're going to do all this. So I'm going to achieve this huge TPS, but everyone else, they can't really be part of the network, so they're just going to have to, follow, right? And so those are ways that we've seen people try to scale this model, but so far we don't really know how to scale this model infinitely, right? We can't scale this to Google scale. So what's the idea that the industry is working on now? And the idea is, let's go from this replicated model to this distributed model, right? So you create a network where every node processes a small portion of the transaction, right? So whereas before everyone was processing the same transaction, we do what Google does and we do what BitTorrent does, which is, we distribute the computation, we distribute the data. Now, what's the problem with this, right? Well, if you try to do this, you have to throw out that instantiation. You have to throw out the replicated instantiation, right? Now, I'm not saying that we won't keep some of those things, like some of those aspects, like consensus and blocks and things like that, but as researchers, we need to be open to the idea that, if we're throwing away this instantiation, that we might come up with a completely new instantiation for that definition, right? And that's an important idea to understand. And so when we try to do this, when we try to come up with an instantiation that's of a distributed nature for that definition, sort of the key problem that a lot of people are coming up with is, how do you crypto-economically secure it, right? That's really the big problem of the day in the industry, right? So the reason why, the Nakamoto paper is so famous is because he solved this crypto-economically secure, like how do you crypto-economically secure a replicated distributed network, right? And we're trying to do the same thing for a distributed decentralization network. So that's the problem of the day, and that's kind of gives you the idea of why scalability is hard, right? And why we don't have like an answer that everyone sort of agrees on. So what about privacy? Well, this is kind of an awkward situation because states of every program publicly visible. That's in the definition. Right, so that's a problem. And you've probably heard about this. How do we solve this problem? Zero knowledge proofs, right? So let's try to understand how that works and how that fits into blockchains. And I'll go over exactly how zero knowledge proofs work from a definitional point of view, try to give you an intuition for what they are. So I'm going to assume a little bit of familiarity with encryption and signature schemes, right? Okay. So we've got 3 players, Alice, Bob, and Carol, ABC. Now Alice has a list, right? So a list of 4 words. What she does is she encrypts that list, and she sends that encrypted list to both Bob and Carol. Now Bob can decrypt that list, but Carol can't, right? So Bob can decrypt the whole list, but Carol only needs to know the first element in the list. So now Carol gets sent this encrypted list, but she can't decrypt it because she doesn't have the key. So what does she do? She goes to Bob and says, okay, well, Bob, you have the secret key, right? Tell me what the first element on this list is because I need to use it for some computation that I need to do, right? Okay, so how do we solve this problem, right? So Bob can just send the first element in the list, but this doesn't work, right? Because how does Carol know that that's in fact correct, right? She would have to trust Bob, and we're in the crypto space and we don't trust anybody. So this doesn't work. So option 2, right? So Bob can, so in order to prove that he sent the correct first element, he can just give Carol the secret key, right? Now Carol can, since Carol already had the encrypted list, she can just decrypt it and learn that alpha is in fact the first element in that list. But she got a lot more information than she needed, right? Maybe there's some other information in that list that Carol shouldn't have access to. Right, so this is not a good idea. Right, Carol should learn everything, so we want to protect both Bob and Carol. So this is kind of the leap of faith here, right? So assume that there is some mechanism, or assume that Bob can write on a piece of paper something, right? Something that will convince Carol of the statement that alpha is the first element in that list, in that encrypted list, right? So assume there is some mechanism, I'm gonna call that pi, something that Bob can write down on a piece of paper, right? And he can hand to Carol, and when Carol reads it, she's convinced that, you know, alpha is in fact the first element in the encrypted list X that she has. Right. Now we're going to make this a little bit more tangible. Right? Assume there's a program V where, you know, Carol can take this thing that Bob handed to her, pass it through the program, and the program outputs true. Carol is convinced. Right. Now, can such a program exist? Right? Like, right, is this, you know, with this magical proof, can this exist? And I'm going to try to argue that, you know, if you've been using blockchains, you've been using magic proofs this entire time, right? This thing called zero-knowledge proofs, you've been using it. So you're all familiar with digital signatures, hopefully, right? So if you've used a blockchain, you've signed a transaction, right? You have a public key, private key, you take that private key, you sign a transaction, you send it to the blockchain, right? And the blockchain is convinced that you own the private key, right? That signature is a magic proof that you produced using a secret that you did not reveal to the world, right? That's a magic proof right there, right? So signature is a proof for the assertion that given some message, which is the message is, oh, send some amount of monies to this address, that's the message. Given a message and some public key that everyone knows, and the message is also known by everybody. I know some private key that no one else knows except for me, such that the public key is in fact associated with their private key, right? So let's go through this flow with Alice and Bob, right? So Alice has a message, she has a secret key, she sends that into the signature generation algorithm, right? And out comes a signature, and she sends that signature and her public key and the message to Bob. And what Bob does is Bob puts those three things into the signature verification algorithm, and out comes true. And Bob is convinced that, you know, Alice does own a private key corresponding to that public key. This picture looks very similar to the picture that I showed you for the zero-knowledge proof, right? Where the signature verification algorithm, you can replace that with the zero-knowledge proof verification algorithm. And that's it. So if you believe that signatures work, then you should believe that zero-knowledge proofs work, right? So zero-knowledge proofs, right? This really abstract concept. How does this relate to blockchains? How do we make blockchains more private? And this is a very complicated subject, but I'm going to give you sort of a hand-wavy explanation of why this works, and hopefully try to give you an intuition for how you can make blockchains more private using zero-knowledge proofs. All right, so the idea is to, you know, put a verifier instead of the VM. So you know that there's a VM that executes transactions. Instead of the VM executing the transactions, put a zero-knowledge proof verifier there, right? And here's what you do, right? The smart contract code that you upload to the chain, that's still known to everybody, right? So you still do that. But instead of the VM re-executing the function call given an input, right, you just run the verifier, and instead of putting the inputs and outputs on chain, you publish a proof that I computed this thing correctly, and you should believe me that I computed this computation correctly, right? This way, you don't have to ever put the inputs on chain. Now, I'm kind of glossing over the output part, but assume that that works somehow. Then you never have to reveal the inputs on chain to anybody, right? So that's one thing that this buys you. It buys you the fact that you don't have to ever reveal your inputs, which means you don't have to reveal who you sent money to and how much, right? Which is kind of the concept behind Zcash. The other thing that this lets you do is, and you have to believe me that we can do such a thing, that we can, so imagine that you have a computation that takes 2 hours, right? So I have something, I have a machine that runs for 2 hours. You can verify that that computation happened correctly, and that verification takes a few seconds, or some very small amount of time. So here's a way where you can, do privacy, and you can do scalability in that, you've taken computations that would take 2 hours on a computer in real life, and now all you're doing on the blockchain is verifying that these computations were done correctly. So that's sort of the intuition there, right? And this is the same picture, except I replaced Bob with a blockchain, and it's literally the same thing, right? So I've got a zero-knowledge proof generation algorithm, I have a program, and I have some program input, right? The zero-knowledge proof generation algorithm generates a proof called pi. We put the program and the proof on the chain, and the validators, what they do is that they just run the verification algorithm, and out comes true, and everyone's convinced that this program was run correctly, and you don't have to ever put the input X on chain, right? So that's the gist of it, right? So along the way, we did the job of a researcher. We wrote down a definition. We came up with an instantiation. We figured out there were issues with the instantiation and definition. And when we tried to fix the scalability problem, we had to chuck out the instantiation. When we tried to solve privacy, we had to change 30% of that definition, right? And so this is kind of what you've heard the soundbite a lot, which is blockchains might not look the same and the shape of them might be different. And this is kind of what the person who's saying that has in mind, right? Like already in 25 minutes, I've chucked out a lot of things that we understand blockchains to be today, right? Now, as we try to solve these problems, we might check out more of these things. Maybe the future blockchains are not crypto-economically secure. Maybe not everyone can upload programs. Maybe programs don't self-execute, right? You might check out more of those things. And so the blockchains in tomorrow might look very different. This is kind of the idea of the ship of Theseus, right? And I'm going to leave you with, there's some Star Trek fans in the audience. You've probably heard of the Starship Enterprise, right? It's a very iconic thing. That's the first Starship Enterprise, and that's sort of the last iteration of that starship that we've seen in canon. And over the 150 years that starship has been called Enterprise, every component on that has been replaced 7 times, right? But it's still called the Starship Enterprise. So blockchains of tomorrow, will they still be called blockchains? And if they are, will they be recognizable, right? And that's kind of the thought that I want to leave you with. Thank you.
Thank you, Ali. Quite a Theseus approach to blockchains. Next up, and our final speaker for the day is David Winterstein. And David, you're in luck. My voice is getting a little better, so I'll actually be able to read out your entire bio here. David is an experienced leader in the mobility and tech industry with a passion for all things mobility. His company, Velocia, is his 3rd startup in the mobility space. It is centered around improving how people move around cities. Velocia is a loyalty platform to reward smart mobility choices. It's creating an ecosystem where users of mobility services can be rewarded for their behaviors and their daily commutes. David earned his Bachelor of Commerce degree from Ryerson University here in town and his executive MBA from Northwestern University. Let's welcome David to the stage.
How's everyone doing? Great. Okay, there we go. Okay. So I want to do something a bit different than, we have about 30 minutes, I think, together. So what I want to do is, I've got a few slides, and we're going to talk about this massive topic of, what is the future of mobility? What is the role of blockchain technology in that future? What are we seeing in the landscape, both here in Canada and the US? And then what I want to do is then open it up for a bit of a discussion. And so we'll see how that goes, and I'm hoping some friendly people I know will kick it off with some questions. And I've got Santiago Perez here, who's part of our team and who's our technical lead. And so if we get into any deep technical discussions, we'll bring Santi up here to have a bit of discussion. So does that sound good? A little bit of energy for the last one, okay? Here we go, guys. So I've spoken at a number of conferences where we start talking about this concept of mobility as a service, right? And so, maybe if we take a step back, traditionally in this landscape, the auto manufacturers are building cars and they're selling it to you, and we're buying and leasing cars. But that's changing, right? I would say if you look at millennials and people graduating out of university, their aspirations are not to own a vehicle, but to use all the different modes of transportation available to them in their city. And so what we're seeing is a forecast that by 2030, the mobility as a service market or ecosystem is going to be worth $1.5 trillion, okay? So that's a significant amount of money and time is being invested into this space. And I don't think that's a surprise to anyone. But what's super interesting is this insight that we've been noticing around where is value being created, okay? Now I would say in traditional models, value was being created in terms of a one-to-one relationship. So I'm a provider, I want to encourage you to use my services, and then as a result, I'm going to reward you by either receiving credits or some type of value within my specific business. And what we're seeing more and more today is that value is being created more so when you look outward as opposed to inward, right? And so that means is we're seeing people are looking at, triple P, which is public-private partnerships. We're seeing this opportunity to look at ecosystems. We were at the World Economic Forum a few months back where there was a whole conference on the digital ecosystem, the fact that people are looking to generate value outside. And so that's something that we really have kind of hooked onto with Veloci and just in general in the space. But here's the challenge, right? This is what's happening right now. So 1.5 trillion in terms of mobility as a service, value being generated from an ecosystem as opposed to the traditional one-to-one. All these new innovations, whether it's Ubers and Lyfts, Getarounds, Turos, scooter bonanza that's going on right now in the US in terms of, Bird and Lime and Spin and, all these different scooter companies. But here are the stats, right? The stats speak for themselves. The fact is people are not getting out of their single occupant vehicles, right? 86% of city commutes are being done by car. 36 billion hours is being wasted sitting in city traffic and congestion, and that translates into about a $305 billion cost to the US economy in terms of wasted time and fuel. So this is the issue that the ecosystem and I would say transportation mobility sector is facing, right? Is that on the one side, there's a massive focus on innovation when it comes to tech, but on the reverse side of the equation is we're not seeing the needle move at all. And so I've been in that space. Our first venture that we launched was called Blancride, and it was a carpooling platform. And I would get on stage here, like I do today, and I would poll the audience and say, how many people think carpooling is a good idea? Raise your hand. There we go. I would assume most people put their hand up. Okay. How many people tomorrow are willing to carpool with a complete stranger? Okay, we got 2, or maybe 2.5, kind of a question there, right? And so that's a challenge, right? Is that, from a concept perspective, a lot of these mobility as a service solutions are great, but from an actual implementation and utilization of it, it's not being picked up. And on top of that, if you take carpooling as an example, which is one of the best ways to get single occupant vehicles off the road, the current way carpooling platforms can incentivize you is to give you more carpooling credits. But what we just realized in this room is that nobody wants carpooling credits, right? You don't want to carpool in the first place. And so the question is, how do we start changing behaviors? And that's really where the focus is right now and where the opportunity is. It's understanding that if we're going to start to see a shift in how people move in cities, that it's not going to be just about the technology. I would say everyone here in the room would agree with me that for the first time ever, technology is available to almost the masses at the most inexpensive, in terms of rates. It used to be where you would have large organizations that are only able to innovate and get access to kind of the best technology, but now it's almost, open to the market. And so what we're seeing is there needs to be a focus on behavior changes, and that's really where we're taking that opportunity. And so what we built is an ecosystem. To tell you a bit about, I'll give like a brief overview, but I don't want to spend too much about what we're doing. The overview is we're building a rewards platform that allows people to incentivize and reward your behavior when it comes to mobility. So if you're in a city, any type of behavior that gets you out of your single occupant vehicle, you're going to get rewarded. And the really cool thing about the ecosystem is that it's open, right? And so that the rewards you earn, whether you're taking public transit or car sharing or carpooling, can be redeemed with anyone in the ecosystem. And this is kind of new when you start talking to our partners and people in the space, is that it's moving away from that traditional one-to-one relationship and moving across the span. But what you'll start to see in the ecosystem and in general in terms of mobility as a service is that you have all these different players, right? You have government, you have mobility as a service providers, and you even have the automotive OEMs. And what they're looking for is they're all looking to derive value in a different way. So when you take public transit in cities and municipalities, they have kind of two focuses. One is they want to increase ridership. You know, an interesting fact is that 9 of the 10 largest cities in growing populations in the United States are seeing a population increase and a decline in terms of transit ridership. And one of the reasons is most likely it's not in terms of, you know, are the newest buses or subways available. It's that as cities expand, public transit and infrastructure isn't able to expand fast enough, right? And so if public transit doesn't get you where you need to go, there's a less likelihood that you're going to use it. So that's one thing that they're trying to solve, right? The second is, when you get to the mayor level, there's a focus in terms of how do we reduce traffic and congestion in a city. And one of the greatest insights that we've noticed in the past year working on Velocia is that the city can't do it all. And this is, you probably are thinking, of course, that's obvious, but I think traditionally what we saw is that citizens would look to municipalities for the answer. Public transit should get me everywhere. I should be able to take a bus and take a subway and get to wherever I need to go. And the reality is that's not possible. But what cities are starting to realize is that they shouldn't be the sole solution, right? That public transit provides a very significant part of the puzzle, but it's not the only piece. And that's where we start to look at mobility as a service providers, or call them on-demand transportation providers. Now for them, they're on the private side. So they need to grow their user base. They need to grow their user base quickly. They want to acquire as many users, as many customers, as many people in this room as low as possible in terms of a churn rate. And second, though, is that they're starting to realize that there is value in terms of working with the city, in terms of going into these public-private partnerships and working together. And so what we're starting to picture here is this ecosystem that's being built. Now you have this third group called the automotive OEMs, and to be honest, they're still trying to figure out where they fit in, right? What I would say is, the days of the past in terms of building and selling cars are moving away, and what you probably have seen in the marketplace is that they're making significantly large bets, whether it's GM's $500 million investment into Lyft, whether it's Toyota's $1 billion investment into Grab. They're trying to understand where is this market moving towards and how do we get involved, right? And so I would say those investments are significantly expensive. Those investments only get them access to one company data set, which is within one vertical of mobility. And so the challenge for them is they're going to have to make a lot of those expensive bets if they want to start to understand how people move in a city. And so what the ecosystem provides is an opportunity for them to test and learn specific behaviors before going into acquisitions. To give you an example, we're having a conversation with one of the automotive OEMs or car manufacturers based in Toronto, and they're thinking about making an acquisition in the micromobility space. Okay, so micromobility is bikes, scooters, trikes, things like that. And so the question that they have is, scooters right now are being kicked out of a lot of cities in the US. And the challenge is because there's issues around safety, there's issues around bylaws in terms of state and federal laws in terms of where does a scooter belong? Is it on the sidewalk or is it on a road? But more importantly, there's this concept called scooter clutter, right? Which for us was a great innovation, right? The idea of dockless scooters. I love the fact that I don't have to park in a specific area. I can just leave it anywhere on the sidewalk or on the street. Well, so for a consumer, that's great. You go over and speak to the commissioners, and they're not so crazy about having kind of all these scooters all over the place. And so that's become a significant barrier for scooters expanding into an ecosystem. And so the question that automotive OEMs are asking is, how do we change that, or how do we remove that barrier in order to expand a market. And I'm not willing to make a bet. I'm not willing to spend $250 million on acquiring a company until I know that. And so what an ecosystem provides them is the ability to test and learn, to come in and say, we want to see, will people change behaviors for rewards as opposed to taxing them? Can we reward people by saying, when you're finished with your scooter, park it in this geo-fenced location and get rewarded? And if they're able to do that and they can understand the costs associated, then they understand the value in terms of whether or not they want to get into the micromobility space. And so that's really where we're starting to see the space move, which is moving away from just kind of making these one-off bets and starting to understand the data behind what's required in order to grow a business, whether it's on business development or the merger and acquisition side. So what I would say is, not surprising, is that the US is a bit further along in terms of their appetite to kind of experiment and launch with this. A bit of a high level, we're going to be launching next month in Miami. But what was really interesting in terms of the discussions I want to kind of take away in terms of where people's minds are moving towards is the idea is, in Miami, there's two big focuses. One is this concept of public-private partnerships. So when we went in and we spoke with the city of Miami or Miami-Dade County, and we had a conversation about, how do we increase ridership? Because in my mind, I was thinking, okay, it's public transit. They're on a decline in terms of riders. We need to provide a solution that focuses on how do we increase ridership in the city and in the county. And what I was shocked to understand was that the focus wasn't really around ridership. It was around how do we solve congestion? And we know that it's not going to be strictly about offering free metro passes, right? That's not the path to a solution. And so what the conversation quickly turned to is, how do we get people carpooling more? How do we get people using car sharing services? This is the public side starting to have those discussions, which is a huge advancement in terms of where this is moving towards. It's starting to acknowledge that there shouldn't be an expectation that the city is required to provide that full service, and that there's going to be a reliance somewhat on the private market. So that was a really interesting thing that we discovered in Miami and that we're super excited about in terms of launching next month. So I want to spend a bit of time talking about this kind of path to decentralization, because I think data is really a key here in terms of not only understanding how we move in cities, but understanding then what the services we require to be able to best move people, right? And so currently, data is owned by the providers. Uber owns your data, Lyft owns your data. It's kind of in the traditional sense in terms of on the private side. And so what we're looking to do is we're looking to create a path and a roadmap, not do everything at once, but really focus on this path to what we call data democratization, right? And so we're working with a team at Aon on this. But really it's, for the first time on Velocia, what's going to happen is users are going to be able to integrate all their different on-demand transportation applications. So if I give the Toronto example, you'll be able to connect your Presto card for GO Train and public transit. You'll be able to connect your Ubers and your Lyfts. You'll be able to connect your car sharing apps, your carpooling apps, your Apple Health, your Google Fit for walking and cycling, your Bixi Bike app, and eventually when the scooters make their way north of the border, your scooter apps. And for the first time, users are going to be able to see a 360-degree view of how they move in a city, okay? Not only in terms of the amount of money that you're spending on the services, but the distance you're traveling. The focus is what is your carbon footprint? How do you look to improve on that carbon footprint? And really kind of a snapshot of your mobility behaviors and habits in a city, which is really cool, right? Now, the cooler part is, as we move forward, is who owns that? And how to create a path to where the user owns that, because that's your data, right? You're traveling, you're paying for those services, you should be able to own that. And what we've been talking with on an example is, let's take those car manufacturers, right? So they want to start understanding how people are moving in a city, because if they understand how people are moving in a city, then they can understand what services they should be providing, whether it's fleet management on the car sharing, whether it's an investment into micromobility. That information is important. And so traditionally, that investment is going into on-demand transportation providers. But that's our data. And so the question is, leveraging blockchain technology, are we able to create a path where users own their data? And through the marketplace, users can decide who they share their data with, how much information they want to share, and whether or not they want to monetize that. And so that's something that we're really excited about, starting that journey, is to see if there's an opportunity to really, change the landscape in terms of the ownership of data and how data is being used as you start planning. Because, having conversations with the municipalities in Toronto, in Mississauga, in Kane County, Illinois, in Dallas, and in Miami, it comes down to the data side of things. Can we understand how people are moving? Can we understand what the trends are? And from those trends, can we provide better services? And only then, I think, we'll be able to see an integrated solution or solutions that are available to you in a city that are going to encourage you to actually use those modes of transportation. Just to talk a bit about in terms of what I think is a validation point, and this is not intended at all to be a plug, but I mentioned that we spoke at the World Economic Forum a few months back in California. What was interesting is that the World Economic Forum wrote 16 business cases on the future of digital ecosystems. And one of the great things is that there was an opportunity to feature Velocia. But what I want you to take away from that is that this is a significant body that is looking at digital ecosystems, the role of blockchain technology in that ecosystem, as well as the role of data that it plays in that space. And so, that's something that's becoming kind of the forefront of topics of discussion. So I think the topic of this chat was the future of mobility. So, everyone's kind of hoping to understand, like, what's the crystal ball? What does it look like? Are there going to be flying cars in the next 5 years? What I think is really interesting is this concept of smart cities, okay? I spoke a few hours ago on another conference talking about smart cities and what's, the opportunity there. A few of the key takeaways is, one is it's going to be data-driven, okay? So understanding, what is the data behind in terms of how people are moving. There's definitely going to be an element in terms of mobility as a service. Having an opportunity in Toronto, speaking with the Sidewalk Labs team a few times, they're looking at, their mobility landscape where, if there's a car in the city, it's autonomous and it's electric. And that is their vision of the future. And so, whether that's going to happen right away or what the path towards that is, I think smart cities are going to play a key role as we start looking at transportation. The other thing I'll make a note of, when you think about smart city, there's a whole number of discussions, whether it's buildings, whether it's housing, whether it's the access to resources. But what every discussion starts with when you start talking about a smart city is mobility. And so mobility is going to play a key role in the coming years as we start talking about kind of the future of our cities. And then the last piece is on connected cars. This is really an interesting discussion. Connected cars, autonomous vehicles. I will say I think we're a bit of a ways out in terms of having AVs fully populated on our city streets. But I think there's a huge opportunity when it comes to connected cars, the services that are available to you in those connected cars, and again, how do we encourage and engage users in terms of better utilizing those services? And so for us, it really comes down to working with our partners and understanding what's required on the behavior change to kind of move that forward. So that's a bit of an overview. I think that's the piece. So what I really want to do is I have a few minutes. I have 5 minutes. So Santi, I'll ask you to join me on stage. But also, I want to put it out to the audience in terms of a bit of discussion, thoughts on the future of mobility, questions you have in terms of the current space, what's happening. I don't know, I didn't plan this, so I don't know where we are on mics and stuff, but use your outdoor voices if you want to get engaged, and let's have a bit of a chat. Yeah.
What's the relationship between what you do and the payments? Because you said you're on the Aon platform, and we're thinking Aon coin, and the general consumer doesn't have access to payments with coins. So what's the relationship between what you do and the consumer and the payment system?
So I'll give the non-technical answer, and then maybe you can jump in. But so we've created a currency called the Velo, which is kind of a play on the bike or a bicycle. The idea here is that for our pilot in Miami, what we're really trying to do is we're trying to keep the Velo contained within the ecosystem, right? And so we haven't really entertained the concept of taking that Velo and putting it out on exchanges. And for now, it's going to be within the ecosystem. So the direct answer is that there is no integration when it comes to credit cards or things like that. Users, when they complete a behavior, So an example being the city of Miami or Miami-Dade County wants you to ride the Metro more. So they're going to run a campaign saying, ride the Metro 3 times this week and earn 50 velos, okay? And the idea is that as you consume velos, you can then redeem them with our partners. And so you can earn 50 velos for riding the Metro and then use the velos to then, get a free 1-hour scooter rental to get you that last mile, or to use on a car share on the weekend if you're going to be renting a car. And so we've created somewhat of a circular ecosystem to start to really limit the integration on the payment side. And what we're starting to see is, that would be an introduction of like a true new currency in mobility that has value in terms of that's being backed by our partners. I don't know if you want to. Does that answer? Yeah, cool. There's like 3 questions, so.
Just a quick question. You mentioned a lot of the players in your ecosystem. Which one is like the hardest to get onboarded onto this? That doesn't really understand it, or that's like the slowest to move?
So it's an interesting, this is being live casted, or, so all of our partners are phenomenal to work with. So I would say they all have their own benefits and challenges. What was surprising to us is that in discussions on the municipality, on the city side, that's a fairly easy discussion, right? Because if you think about it from the city side, the real option that they have right now, or what they're toying with, is the idea is that, spend $6 billion on a light rail infrastructure, right? So the challenges there are a number. One is that you have 20, 25 years out before you realize that. 2, it's extremely expensive. And 3, who knows what the population demographics are going to be in terms of how people move in a city in 20 to 25 years, right? And so are you running the risk of making a significant investment and you have a shift in the city population in terms of where people are living, and then that doesn't really solve your solution. So what I would say is that, working with municipalities has been actually quite easy in terms of initial buy-in and understanding the value. I would say anyone who's ever worked with a city can understand that there are some challenges as you kind of go through it, but it's been fairly positive. On the private side, it's been pretty straightforward. I think all of them are starting to realize the value prop there. What I would say is on the automotive OEM, again, it's more around the pace, right? There's always this balance in terms of startups want to, change the world, and they want to do it, by 7 o'clock tonight. And, the large kind of, corporates, have processes in terms of how they move forward. And so I would say on the automotive OEM side, this is a massive shift in terms of how they think and how they process. And so there's definitely been an understanding and a willingness to engage. But in terms of, really moving forward on that piece, they're going to, they've got processes to kind of follow. So I would say no one's been too difficult in terms of, really, justifying the value of an ecosystem. It's been more around, okay, we get that, let's now kind of coordinate internally. Yeah.
How do you value the different parts of the ecosystem? And how do your partners then respond to that valuation? In other words, an OEM versus a scooter, for example. I mean, there's some logic behind how you would value those from an ecological point of view, for example. But how does that all work?
So in terms of the actual value of the maybe I'll describe kind of how the process works in our interaction with our partners. So the first thing is we fix the value of a velo at 10 cents US. So all of our partners see the value of the velo doesn't change on that side, both on the behavior side and on the redemption side. On the behavior side, what we do is we sit down with each of our partners and we understand what is the behavior that they're trying to influence, right? And for every partner, it's different, right? So for small or medium-sized mobility as a service operators that are fairly new in a city, their focus is how do I get more users, right? I want people downloading and registering my app, and I want to use your platform to be able to incentivize that. And there's a belief or a concept that if it's costing me $50, in this closed ecosystem, I could probably get it for $40 or $30 in your ecosystem, right? So that's how. So we don't actually set the value in terms of you're going to spend X on this campaign. Our partners say these are our internal costs, and this is what our willingness and what we want to start to experiment with. On the flip side, on the public side, it's first, what is the behavior looking to influence? Is it public transit? Is it carpooling? Is it cars off roads? So really starting to understand what that means. And then second, what's the value there, you know? And so we can provide data and insights, but really it's understanding from then what the value is. And a bit of this is going to be test and learn, right? You know, the value for a partner might not match the willingness to behave by a consumer, right? And so what we're going to start to see is, you know, where do those kind of meet and come together? And then on the redemption side, it's purely as a currency, right? And so, you know, you have 100 Velos in your wallet, which is $10. You can take that and, you know, with any of our partners and redeem that. And so from the redemption side, on the user side, it's fairly straightforward. And anyone that's curious, is what we do is, without unlimiting integration requirements, all of our partners give us some form of a promo code or QR code. And so that way you can just drop it in, because what I would say is the future of mobility is probably some form of integrated mobility, you know, one-stop shop as opposed to all these different applications. I don't think we're there yet. And so what we really want to make sure is that that in-app experience you're still having as a consumer is still happening in our partners' applications. I think we had one more question in the back from an eager gentleman. This is probably for you.
No, this is for you, David. Awesome presentation. Obviously, we're big fans of Velocia. So what I'm interested in is these mobility as a service partner groups. They're essentially using your platform to pay people or reward people to do behaviors that are beneficial to them, whether it's download the app or use their service, or from a municipality perspective, more on the less dollar value and more things that are better for the municipality.
Right.
Is there an opportunity to expand that thinking to liking their page on Facebook and kind of the more broad data sources, and also that makes your network more valuable because you're porting in more data sources, and kind of expand it out of specifically how you move around and more some of it with mobility as the key pin, but the broader ecosystem even farther around it?
Yes, so good question. I'll answer that in two parts. The first part is, yes, there is an opportunity, to the point that we have spoken with a few of our partners to say, you know, they're trying to get more information and interaction with their users. And so is there an opportunity to, let's say, whether it's even liking tweets or Facebook pages, but more around running surveys and getting direct feedback from a user in the app, so that way they can kind of feed that into the mothership or HQ to be able to provide better services. So we're in discussions, the team is working right now in terms of having that integration when it comes to, you know, whether it's surveys, whether it's notifications, whether it's, you know, PR or things like that. The second question is, you know, does this expand outside of mobility? And this has been something that we've been thinking about a lot as an organization. And for today, the answer is no. And what I think the reason behind that is there are other partner or players in the ecosystem that their rewards are agnostic. So it's anything from a Starbucks gift card to an Amazon gift card to, you know, Hewlett Packard, you know, things. And so I think that's fine. But it comes back to, what are we trying to do? And if I were to say what the ethos and thesis for the team is we want to fundamentally change how we move in cities. The fact that 86% of people are driving cars and sitting on the DVP or on the freeways or on the Gardner, and emitting, you know, what I would say is the largest amount of carbon emissions in terms of a city when it comes to transportation, isn't good. It's not a good thing. It's not where we need to be. And so what, you know, I want to hit over the head is that it's got to be around mobility, right? That if we take this out of the ecosystem, you're going to, and say that you can use it for anything, what we've seen in terms of the stats is you're going to go do whatever you need to do on the behavior side to get that reward, something in your mind that you want to get, whether it's, you know, something on Amazon or whatever. And once you've done that, you're off the platform. And so what we know is every single day people get up in the morning and they commute. And every single day they come home from the office and they commute. And so if we can reward people for their commuting behaviors, and we can start moving the needle in terms of getting people to change their behaviors. One very quick story, we spoke with the venture capital firm, and the individual was based outside of Toronto, and he drove into the GO train and took the GO train to Toronto, spent his day here, and then went back home. And so I asked a question saying, would you carpool to the GO train? And he's like, no, like, I would not do that. And so I said, okay, cool. I said, would you carpool to the GO train if by carpooling the GO train, your GO train ticket was free? Okay, that changed the whole landscape. Now, I'm not saying that every single person that's going to move the bar, But if, let's say that does move the needle for you, and let's say you do that once, you do it twice, you do it 30 times. On the 31st time, odds are, I don't need to reward you, you're naturally carpooling and there's going to be that behavior. And that's where you start seeing the behavior shift. So that's a really long-winded, and I can continue going, but answer to say, we're serious about mobility and changing how people move in cities, and so that's going to be our focus for the near term. But definitely opportunities as we expand. Anyway, thanks everyone very much.
All right. Thank you so much, David and the Velocia team. We've had a lot of fun working with these guys over the course of the last almost a year, I guess, at this point. So that being the last talk of the day, I just wanted to leave you with a couple of concluding thoughts. This isn't going to be too long, and then we're going to kind of let you go on your way. But first of all, thank you so much for joining us for this first year that we've decided to put this event on called Rebuild. I think if I just think back over the last 2 days, beyond the companies working on interesting products that we've heard about in mobility and gaming and finance, I think it's important to realize that there's a deeper message here that we're trying to get across. The message that we heard yesterday from Robert McChesney, this morning from Tanner, that there is a very deep fundamental problem that we're trying to solve in the internet that has very deep-rooted implications on society. But the other thing that I had a lot of enthusiasm out of these last couple of days is also realizing that there are an incredibly large number of passionate and intelligent people in this ecosystem, and that we should be spending more time together, because before we go rebuild the world, we probably need to start making sure we get our own affairs in order within the blockchain industry, within the Web3 space in general. So, I think a quick call out to everybody who has, decided to spend the last 2 days with us. We're going to look to make this a little bit more of an ongoing and recurring dialogue that says, one, let's stop talking so specifically about why one blockchain and one coin is better than another. Two, let's make sure we keep at the back of our minds this rooted understanding of what are the problems that we're really trying to solve that are societal problems, that are internet-wide problems, not just blockchain problems. And three, hopefully we can start working a lot more closely together to kind of accelerate our path and increase our probability of having that positive impact. So, going back to some of the pessimism that we heard at the beginning of yesterday from Robert McChesney, and the message this morning that kind of resonated to me from Tanner was that we go through these cycles of technological optimism and technological pessimism. And broadly around the world today, it really feels like we're in a cycle of pessimism. It feels like everything seems negative, and data privacy looks like it's unsolvable, and Facebook's out to, take advantage of you and all of these things. I think it's incumbent on us to really start thinking about how do we re-inject optimism. And we can only do that if we approach this with positivity and solutions rather than negativity and problems. So, here's to hoping that the next couple of years in front of us as an industry, as a community solving the Web3 space, we really start to bring that positivity and optimism to the rest of the world so they can understand how important it is, the work that we do. So thank you so much for being here. We hope to have you again with us next year, and all the best. Enjoy the rest of Toronto Blockchain Week.